welcome. Good afternoon after that delay. We are here.
Month with the bank. Well, Memorial Day, Labour Day, sorry, write-off. You know.
Did you have to work? You didn't.
Right. Yeah. Not like it's not like the trading desk, is it? Where they can just sort of take the afternoon off, really, because there's no US session. But
yeah, well, we were very much guilty of that back in the day. Yes. But are we going to have new highs in the equity market for our brand new Shuru? Maybe not. Got new highs in gold. So, a gold today's. Well, we have myself and Chris through until 8:15. I think, yeah, there's now that we've missed the first 7 minutes technical difficulties, we'll go straight into over. So, Chris, what was your top story for?
It'll be this morning's video coming in, isn't it? It's not the most important story of the day, but it is the poor old Nestle CEO has caught. Maybe the phrase I can use at this time in the morning?
That, yeah, you could definitely use that one. Let's just release here from this story because it is going to move the stock today. So if we can get that up on screen, Nestle has decided to take a break with its CEO. Unfortunately, they have to announce the company has had to wave cheerio to their chief.
Did you write this on AI this morning?
Originally, the CEO had denied the relationship with his, but it looks like he was just trying to be a smarties pants. There was an aero surrounding the romance for a while, but the board has finally burst the bubble. Proof came after the pair were caught in the office after 8 in the evening. Apparently, he's gone. We've seen off Chris Beecham with the puns.
I love a pun, but that's too much at this time of the morning. It's only 2020.
You're just jealous because I've stolen them all from.
That's the best I could think of, but yeah,
that's a good start.
And I thought that the photo of him in the Times. I don't know whether we can get up the photo that you've got in of him. It's much more flattering than the one the Telegraph used.
Yeah,
makes him look a bit more suave. That way, the Telegraph's photo wasn't as kind.
Where are we? It is. Let me just see if we've got the. Yeah, here we go. So the have on freaks.
Yeah, that's a bit better, isn't it? There's something about getting all his corporate there, but further on that. Sorry, let's be serious. Very serious matter.
Be very, very, very serious. Because the shareholder, you're not going to be impressed. It's another. What was the head? Yeah. Just another one of these. It's just such a waste. You just your strategy going. You've been in the business for, and
fallibility of human nature. You know, it's time to reflect on. We're only human, not to excuse it, but at least he wasn't caught at a concert.
Yes, very true. Great concert though, Coldplay. I can see how they ended up hugging.
CEO affairs are like buses. You wait for one and then two. They really.
Right, so, but elsewhere in the Financial Times, what it looks like is looking to buy a
Politics isn't working for the majority of people, you could argue, and that people want something done. And in those situations, you think of the major dictators, but if you look at Europe by 19, there were very few democracies left on the continent, really, outside of, say, France, the Netherlands, and the Nordics. If you looked at almost the rest of Europe, it had gone fairly conclusively dictatorship, actually.
And that was because of the problems in the late.
I think you'd have to, yeah. The military taking over. So I'm reading a book on the 29 crash at the moment about the central bankers, and it said that there was, when the Chilean 3 days something. So
it's like France.
Yes, exactly. Splitting. No, people can see this pressure on the Fed, this attempt to when he's sort of moving the US in a slightly dangerous, because some say that if you're Trump, you'd argue that he's. So and it's interesting that you've got the very dangerous course,
and that's exactly what the FT point out. His comments to the FT, prominent financial residents' policies.
And of course, long distance that the US active stakes in companies, but perhaps you can argue General Motors clearly was a linchpin of the economy.
Yeah.
In a way that, okay, Intel is an important part of the US economy, but it's not. This isn't a financial crime.
And from the success of the company.
To the US to China, which you might argue is simply a tax of some sort, but then it's a fine line. What is an if he's going to get, and here we could have a long and boring discussion about is a central bank ever really independent, but if the world's financial system is and you have a president that's going to really, what's the word I'm looking for here, push people into doing what he wants them to do.
Manipulate.
It's probably the word, and that has unintended consequences. What does that mean for the confidence in the financial system, for a host of assets, for markets, for the dollar, for everyone's economy, really? He is playing with fire, I think it's easy to say, without being too controversial.
And the gold prices really start
500 this morning, as we were talking Friday. Was it Thursday we were talking about it, weren't we? I said silver at 14-year high yesterday, partly for other reasons, but yeah, the weakness, the flight to safety gold, I think, is a flight away from chaos, perhaps is the more accurate phrase, because you had the huge because of tariffs. Got another in gold now after what's been
Your tuck is also in there. Good. Yeah, definitely. So yeah, we've got there. Let's take a look at all market and thereabouts, but we that 9200 vol above 18. That we've got to keep a look.
And Bank of America warning yesterday that you had year-to-date lows for the VIX following the Jackson Hole speech, and there's obviously the caution that the volume is unsustainable to them. Though any August volatility autumn volatility, would be by the dip moment. Okay, argue, but it's certainly they're warning there that. That's it.
Well, that takes us on nicely to report this morning on the good, the bad, and the boring. We'll miss out the boring. So, what is the good news we have at the moment? Well, the good news is that global improving consistently since May, right? Of course, we had the April hiccup, but since May, everything's been improving. The global news pulse, which is on the 30-day, has moved up and down since 2009, but is currently improving. Secondly, cross-asset momentum. This comes from SocGen. That certainly is still in the bullish sign. Now, the VIX we were talking about, if the VIX in a row, historically the S&P was higher 100% of the time 9 months later. Don't know what happens.
In the middle, yes, as ever, it's the journey that. Yes, good point.
Put call skew based on single stock options prices for S&P 500 companies is at average levels relative to the past years. And of course, those investors are still buying ETFs. No matter what, I assume at the start of the month, you see that ETF.
Might be interesting to see, yeah. Come on then.
What's the other side?
News, Rich?
September has a long history of being a tough month for the stock market. It's been particularly true in the S&P 500 during September. If you see everything at if it closes August at an all-time high, right? If it closes August at an all-time high, the index was red for the month of September 14 out of 18 times, with an average down 1.6. It's a little bit scary. Out of the top trades across the US, the top 200 insider trades over the last week by value were buys.
I think I've seen.
sell orders of the top 200 from management.
But selling for what reason? It's always when we've looked at director dealings before, or you can argue it's easy. Just as
zero.
But yeah, zero. But yeah, this is record highs in stock. So yeah.
And then, of course, our old friends is positioning in US equities.
It was. I think it's going to have a bit of a down.
Right. It sounds like we're in the studio and we've had a few problems, but we still
Good.
think. You also have a halo above you.
No, we both have halos apparently.
Yeah.
So it's the new lighting.
Thank you, Jesus. Cool, Jesus. Right, so what country is the chart of the day from? That is the big question. It's going to be a commodity today.
Oh.
I think our team's quite good on there.
That narrows it down quite a lot, doesn't it?
Yeah. Yeah. Let's see. And are we ready? 3, 2, 1. Who's going to be the first one in the new studio to get chart of the day?
With a disco strut, but is it real or just a little bluff? Neon lines and a price so bold, moving stories Wall Street told. I've got my mouse and a disco heart, feeling brave enough to guess that chart. Guess the chart under the lights, is it breaking out or faking highs? Silver could be soy, could be junk bonds dressed like a playboy. Sequence throw riches stressing the chart. Like a candlestick on freestyle. Zoom out, zoom in, who really knows? We're just guess the chart, keep the pace. Is that a breakout? Some face. You can analyze or dance real hard, but deep inside you'll guess that chart. Guess the chart, don't look back. Every move's a disco track. Could be boom, could be bust, be a
So it was. And well done, Boise. I think that's the first one you've ever managed. See, we of course threw the wobbly in there that the at the top was still Broadcom.
Broadcom from yesterday. So
good. Okay. We're near serious business here. So at last, my watch list back for the London. But the big question is, do we have a bell, Chris Beecham?
bell.
The bell still exists.
Yes. It hasn't disappeared, sadly.
Goodness, I thought.
I thought we'd have put.
How can we spend £500,000 on a new studio?
Nice new bell. We could have gone to the White.
Right, we're really.
Snag list.
5th of October. So we've got a closing bell party at the LSE. So I think it's going to be our time to get in there.
Okay. You're going to nick the bell, are you?
Yeah, nick their actual bell. Right, 20 seconds to the open then on this, the 2nd of September. Are we ready, Chris Beecham, to ring that bell with...
Champing at the bit.
Just screen, please. Get my watch list up, and we will. Barclays small up 30 basis points, Burberry up 60. What else are you seeing on the downside there, Chris?
Cardo down 1.4%. So out there. So Imperial Brands probably down in sympathy, of course, with British and American tobacco. Interesting, Glencore still off a little bit this morning as well.
Yeah, that was especially weak yesterday.
Yeah, Lee was downgraded as well this morning, but not seeing much impact from that really. And it's still a dearth of news updates really today as well.
Yeah. So everybody waiting for the US Open, which of course will get the all sessions at 9 a.m. But it all kicks off on quite a busy week for the old economics.
Yes, although we've got 2 p.m. today, Trump announcement of some sort. Nobody knows what it is.
Oh, really?
Probably found $10 under the desk or something. But yes, after the weekend, of course, where there was that health rumours and he appeared. But yes, there's an announcement. Yeah, he's declaring himself president of the world or whatever, something like that.
Right, not too much going on in the UK. If we're getting a bit more in Europe, we've got the luxury names are roaring.
Yes.
So Kering Gucci, that's
okay.
since its fall.
Okay.
So up 3%. Remember, we were looking at buying that one at 180 euros, 236.
And so 100 euros.
Right, and then that's where LVMH is getting its.
Also, 6
below 630. Siemens, Renault, there's Hermes. Great.
1%, yeah.
It's amazing what an upgrade and downgrade to do, isn't it? That's a 4% differential between Gucci and Hermes just because of those.
Yes.
And yeah, L'Oreal, small down, but not too much going on. What about in commodity world? Let's see how silver is doing after it being chart all day. 40.
$40. Doubled since the close of 2022, isn't it?
Oil picking up again. 65 now. It's like every day.
Yeah. It's quite resilient price movement there in oil. It seemed like it was headed for a big downward move last week, and it's recovered quite impressively, really.
Yeah. Small recovery in iron ore overnight. That was up around 1% in copper. Didn't quite hold the $4.60 yesterday. And then on the currencies, Chris Beecham.
What have we? Slight weakness in cable euro and euro dollar. Dollar yen surging away again this morning. Continue hiking rates, but and let me get this headline correct. It was a kind of with some caution of the overall. I forget what the phrase they used was. Or economic situation, or the global political situation. BOJ must keep raising rates, but focus on global uncertainty.
Okay.
Deputy. That was the Reuters headline.
And let's revisit your trade of the week from yesterday.
What was it yesterday? Oh, dollar CAD.
Dollar.
Doing this morning, he says, with trepidation.
Right, remind everybody what.
I always worry when I take the week because I'm long dollar CAD because it's like being allowed to drive. Sort of where I'm going to break his streak. So,
did you ever do that?
I have done, yes. I didn't crash it though.
Above the age of 17.
Oh, of course, all perfectly legit.
Not a Ferris Bueller.
Slightly higher this morning. I can't say it's exactly rocketed. I recommend, but it's only come back off again the early hours of trading. But
yeah, so it gets sent out at midday, doesn't it? So we'll give you we'll give you the benefit.
Yeah.
But yeah, not much going on in that. Good. Right.
What is a busy week, of course, for data?
Yeah. So let's come off the screens then and let's look at the economic calendar. So we've got coming up at 10 a.m. this morning. The gents can put that one back up. Eurozone inflation on the ECB.
Yes, well, you had actionable this morning saying that they should think about hiking rates, which is bound to send a bit of a chill through everybody, I think, at the ECB. Bundesbank doing it.
3 p.m. this afternoon, we've got the ISM manufacturing expected slightly higher than last month. 9.
But of course, relies on the prices, which is slightly said that. Aren't we? Prices paid perhaps more important than the actual ISM PMI itself.
Absolutely.
Really.
You want, is it 65 on new prices and 48 on new orders?
Yeah, it's not great.
Low stagflation. Week then we've got, of course, the services PMI.
Yes, a similar story there, isn't it? Watching the prices paid on that one as well, and of course ADP's on Thursday as well.
Jolts tomorrow.
Yes. Okay.
If we still care.
Very much the train spotters economic data, that one.
11.
I'm not surprised.
And there's the services. 3 p.m. Friday there. Okay. Purchases from you. And then before we get on, then the payrolls there. So 75,000 is expected. What kind of cat is thrown amongst pigeons if that comes in at 150,000?
Yes, exactly. That's going, and you're going to see a lot of volatility. And watching, obviously, those earnings figures, participation, because that's the key one.
So Chris giving you a earnings, sorry, the increase year on year there, an insight into inflation, and of course today in the prices paid in the, those are the kind of things that are we'll be watching.
Yeah, because I really think he just opened to September, pricing that in, and because there were the last it was now, but it really.
Exactly. Yeah. However, before we hand over to Angela come in and grill you, did just have a birthday wish.
Yes, happy birthday to Prime Minister of Great Britain, Northern Ireland, who is 63, to have cake at Cabinet this morning and then maybe play games.
But no, as long
Boris didn't go down the well with that one. And how old's Trump?
Oh, I thought it was 8. Is he 8?
Start with an 8 now.
I think it does. Yeah.
Good.
79.
Let's update. I see one of you is talking about UK 30-year bond yields. So let's look at those. 5.67% now on the 30-year versus 4.96. We've got to watch the US as well. US is taking up. If that goes to 505 with this month's data, then I do not think we'll be seeing equities starting with a 6,400.
Going to get a very shaky moment. Yeah.
And you know, all this feeds into this gold move higher. It's going to be a big week.
Big week, actually. Back to normal.
Yeah, back to normal. And we're trying to just get across the theme to you, right? So bricks in the background. Let's see how quickly the guys can come to a wide shot. Oh, listen to them. Oh, so there we go. Right, so there is a theme to how many bricks are in the wall, right? Because there was a long discussion how wide to make the depth, and we decided to go with how many times Angeline has said trader friends in the first 250. Yes. And so there is one brick for every trader friend. So every one of you has your own brick.
Very good, very good. That's how many times you said Vodafone, but there we go.
Started selling them.
I'm sorry, you can't just drop that bomb in there.
Just a little. Good. Right, time for Angeline to come in. We'll see you in 2 minutes after the break. instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets. Find the perfect opportunity. So if you think the market is going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. This increases your profits on your trades, but also remember losses are also amplified, so be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, the minds are ready, time to go. Hey, come on Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
So I'm not sure what the difference
Hey, 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 trader friends! Welcome back to our brand new studio. Lots of
too clean,
wonderful comments this morning. Thank you very much, Kirky, Ian, your support and love all the way from here, despite wherever you are. Neil, I know you're in transit. Thank you so much for listening in. Pleasure to have you on.
It's very good to be back.
Everyone talking about your halo.
I know.
Anyone could see it.
I've been polishing it steadily over the summer.
So it's great to have you all back in. Rich and I have both been banished, and Chris as well, to our homes whilst they were tearing all this down. But it's now all going to ready. Yes, every is thanks to all of you, because if not for your help, do we have an applause button? Yes, there we are. If not for your help, we wouldn't have had these bricks and the spend, of course, signed off for our budget. Morning, Boston, Frank as well, and Yoga. London using the metric system. What is that about? Let's get this across.
I don't.
The markets there, like a slight a day as well, a bit of digestion, really.
Yes, yeah, certainly the DAX taking a bit of a nasty tumble at the open, dropping like a stone through last week's low. So as ever with US holidays, it's a bit like having the adults out of the room and the children allowed to play. You shouldn't really trust the moves you see on a day. They then tend to last. And so we'll wait and see what happens. But yeah, the DAX dropping 200 points. LVMH, really quite chunky price targets on them. So it's interesting to see them landing.
Yeah, interestingly enough, Hermes is down a 0.6%, but it has to be said they have been going up.
They were downgraded, so it was interesting. And Burberry up a little bit as well in sympathy. in the UK sector. So there we go. A morning that is very, what's the word, a dearth of RNS updates this morning, just one or two really to look at. All week, in fact, it's a very big week for macro, not so much for company. Nvidia really bringing down the curtain on US earnings. Really had this to get back to full steam market.
Try and put. Yeah, so this is Nestle chief of on share price over the years. So Nestle to see where we're at. When I last checked, it was down. Ta-da! I did not plan this, trader friends.
Down 3%. There we go.
Aha! There we go. Yeah, we are. So there is a lot of analysis out there about the impact of CEO misconduct, and if all those surveys are right on past misdemeanors, then you'll see this unwind after about 3.
It might push a little bit lower in the next couple of days, and then okay,
yeah,
you wait for the. Not that it was on a great run before then. Has to be said.
Yes, Nestle, of course, looking at the share price here, we're looking for something with a clear downtrend. This would be it. And Nestle has been trying very hard to diversify and also create products that are less catered and more suited to the rising business, because they apparently have it. Have you heard? Yeah, they're less inclined to eat salty foods as well, apparently early analysis has shown.
Oh. There you go.
So James is saying, so the Milky Bars aren't going to be on them. Oh, shh. Speaking of which, lots of macro events. I heard you talking about this earlier on. Some of the ones that you don't rate this week, do you think because it's...
well, yes. I mean, it's JOLTS is perhaps the one that people have started to look at again after years of really caring. Pops back into the charts occasionally and then disappears off again, really. ISM, the PMIs in the US, the key ones to watch, driving the dollar, and then, of course, payrolls on Friday will be the really big moment. It's ahead of... What is the Fed meeting? Is it the 17th, 18th, 17th.
Yes, I think it's the 17th.
Yeah.
And still cut expected.
Yes. Yeah, as we were saying, we think that September is not guaranteed. Nothing is ever guaranteed, but very much likely next. Is what the dot plot will be saying, or people expect the fundraise to be at this certain level, of course, with so many people shamelessly auditioning for the top job in front of power. You know, I want a 100 basis point rate cut. I want a 150 basis point rate cut. It's very much I'm Spartacus.
Chris is never. His perfect diction means that we have to guard popping. That's why. Right, gold. Mervyn Jordan here. Trade gold, and you don't have that problem. Same for earnings. There you have it. Yeah, the low interest rate. Let's have a look of gold, and I know you already covered silver, but let's have a look at gold here because it's
3,500 or yeah. So sound the gallery, doesn't it, really,
yes,
as well?
yes.
What did they say?
Yeah. Pop scene.
Gold or Powell.
Yes.
Began to rally on the Wednesday before he started speaking, and then took off on the Friday, and hasn't really looked back since, has it really? So, and as we were saying in the morning, it's rewarding people for holding gold over those months of consolidation in April. Has taken this length of time to finally break higher. So it is a bit of a lesson in patience, it has to be said.
You are causing me pain, you know that, right?
Why?
Because I was impatient.
Oh, there you go.
Right.
But the second mouse cheese.
Because I'm one of those that this is not advice, really, because I was impatient.
Badly.
Yes, I was impatient this time around. I thought it's been nothing my responsibly.
And then you closed it out?
Yes.
Oh, it's always the way, isn't it? I'm bored of
it was
this now.
last week because I didn't want anything bothering me on my. So I closed out and I came back to it doing this.
Oh, you can check it really easily.
On my mobile, yes, but then
Like
not,
the 1920s, you have to wait for a telegram.
Not when I'm out at sea on a paddleboard, or a canoe, or a perception.
You're doing an Angela Rayner where you want a canoe, drink, vaping, and.
I've seen those
Brighton
pictures.
seafront. Oh.
I may have lack of connection and Wi-Fi, but I have seen those pictures because I was sent it.
Sadly, we've all seen those photos.
Oh, yes, but I'm going to show you this because this will be of interest to you, and you'll see there, you know, the. I'm going to FNF11. I've missed that, guys. You saying FN11.
They shout it in my ear constantly, so it's any consolation.
So yes, you can see, the move there and how it relates to dollar, as we see the dollar going down there. So this is a chart, two charts there, merged together, helpfully for you to see that correlation. And those charts.
Very whizzy chart for this morning. Done. Is that yours?
I combined it. It's from.
Yes, you do right.
So there you go. That's what we have in terms of friends. If you've been looking at loads of do let me know. I know some of you have been messaging me in Sana. So that was a lovely moment yesterday when you. And it is still slightly higher. This quote is from a very reputable analyst, but I have to keep this person anonymous because he's asked and concentrate before export. So there you have it. So there's a word of. Ever dabbled in rare earths, Chris?
No, I can't say I have. And there's a theme, of course, with China and Trump and the fallout there. Where are we going to find our rare earths if not?
Right. We're being told we need to go for a break. Just a very quick overview for you. Rich and Tom are waiting in the wings, a bit of a risk off. Start to the session. However, that is not a huge surprise given we've got such a big week and jobs and.
It's very much weaker this morning. One of its components down 5%, so that's what's clobbering.
Yeah. Tom and Rich coming up next. Thank you so much, Chris.
Pleasure.
If you're looking for flexible financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. If you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less. So this increases your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Today, join the conversation and be inspired to make moves. So our first to be Tom.
It's a Manhattan look. Working.
You like it?
Yeah, I do.
This is what I had visual for since about December time.
Really?
And the work that has gone into choosing the wallpaper.
Well, I mean, the jacuzzis is a surprise. I'm looking forward to that. Yeah, no, it's got potential. Nice work.
Thanks very much. Did it all myself. Now, commodity world. My
Yes.
expert. Just last time we were on, Tom said that he was bearish on copper, and about 7 hours later, copper %.
Appointment.
Some people do watch it on playback, so it was nice you gave them that time. Now, you've just been doing times with investors, chatting up with them after. What is their current thoughts on the
Hashes series, which
Right.
is great. So we're on the right track there. Outright depression because they are back from holidays. So that's just the last, well, today and yesterday. So a lot of people that are pretty down at the moment. And in my world, they're sort of focused on still Trump tariffs and the fact that the world's splitting apart. And so they're sort of expressing that subdued outlook in our equities, which is a bit tough.
Yeah.
So,
And is that split on yesterday and over the weekend?
well, I mean, Trump-led confusion. So he sort of catches up with his mate Putin in Alaska, and then Putin catches up with his mates in China. So they're doing that this week. So I think the individual investor out there is very confused about where global growth's going. Trouble. So they're all thinking about those sorts of macro themes rather than good old-fashioned supply-demand fundamentals, which I think about. So it's pretty weird.
And which one's winning at the moment?
Without a doubt, gold. And if you gold, buy a bit of silver because they're both in the same direction. So gold sort of touched on record highs. I think 35.
Let's get the chart up for.
I mean, you're a bear going, so sort of trying to put up with that. But yeah, it's not cut it. It really upsets some investors when you talk about S&D and gold world because it doesn't really matter. But there is a concept of demand. People buy gold, put it in a back room for expectations the world might fall apart, and so on that basis, there's a real demand driver in play. So,
But it's got the momentum behind it just now, doesn't it?
it's a full-on momentum trade. Again, when you get incoming abuse and you've got the opposite call in place, momentum's underway, and they're part of the trade, and have fun with it, But they are risky trades. If there is an end to one of the conflicts in the world, so Russia and Ukraine suddenly do a deal, then that would take a big chunk out of the gold price. If China and the US sort of come up with sustainable agreements around trade and tariffs get scaled back, that's bad for gold. So these things can turn the gold story into a bear story very quickly.
Do we have a better sort of prospect for silver?
Well, they roughly track each other, but in this environment where global growth's under pressure, The other important driver for silver is industrial demand growth, and that's under pressure. So silver should actually underperform gold in a weak growth deglobalization sort of scenario.
Yeah.
And if it reverses, like solutions and tariff rollbacks and so on, then it should flip. Silver should outperform gold. So you should always keep in mind the industrial driver. That's an important differentiator. But generally, the prices track each other.
And so that's predominantly global growth and industrialization.
Yeah, and silver feeds into photovoltaics mainly and other industrial applications. It takes up about 50 to 60% demand for silver, something gold just doesn't have. It's a financial play.
Right. Which one would you feel more comfortable in if you had to choose between the two?
Look, I am a bear on gold. We talked about this last time, but right now in this environment, I'd be quite happy to hold gold, and so my preference is gold over silver.
Okay. Shall we move on to iron ore?
Yeah, sure. Let's do iron ore. Also an unhappy story. Well, it's not an unhappy story. It's just sitting there like a stunned mullet, as we say in Australia. It's not doing anything. So, stunned mullet is a fish that's not doing.
Sorry. Right. I thought.
No,
the hairdos.
not the hairdo, which is coming back big time, isn't it?
Oh, it's back.
Mullet haircuts, moustaches. We did marketing in Australia, and that's the new fashion. And I literally haven't seen that since the 70s, and I'm unsettled.
And for people as well, not just the usual mullets.
Friends of mine have it. It's really weird. I think you'd look okay with a moustache mullet combo. You should look into it.
I've thought about going full shave for the new studio.
Right.
So we'll get very professionally dressed. Probably not a tie.
Okay.
Yeah.
Send me the instructions for the next chat. So,
right, iron ore. Let's have a look at that one, guys, because as you say, it's just done nothing. $770.
Yep. My job is to write stuff about that chart. It's pretty hard. Sometimes I make things up. But we're coming into a tricky time of the year for iron ore, and this is a problem for Rio Tinto, BHP, FMG if you're in Australia, Vale, the monster out of Brazil. Start to wind back their steel production rates. They destock all their raw materials, don't take phone calls from Australia or Brazil, and take assets offline, and we go into a decline. And that typically reports all the way through to that flagship signal for the iron ore. My expectation is some downside into Q4. So I will have iron ore exposure until later on in the year. So it's mostly iron ore,
okay,
and it's very similar profile for BHP. But they're in this stock, and these diversified stocks, they're also trading the macro reality. I mean, here I am talking about commodity exposure, but if there's in the commodity price action, residual driver is macro, and as we've chat today, it's not great at the moment. So investors in resources regard this space generally as a risk trade, and be withdrawing from it and putting it into a safe. They can do that. Resource-only investors can't do that. They're sort of and they'll probably go to the cash cows with top quality assets, and BHP benefit from that trade. But the generalist exit is a problem for them.
And then, what about? Are you getting incoming questions about the dollar? And if we see a prolonged sell-off in the dollar?
Now, commodity prices, and we're talking about gold and silver, but they're actually all lifting. So oil, copper, aluminium, with stuff like nickel and tin. There's a general lift and mechanical response. So that's the mechanical response to US dollar weakness on
there's certain portfolio managers have rules like, and it's right. Okay, the inflation trade. Well, that is mining and commodities, but there are certain inflation trades that are stagflation.
Yeah.
And that's it's the opposite.
And you can commodities short term on the inflation risk theme. So copper and gold, for example, in the last 3 pretty much tracked each other, even though copper's essentially an industrial metals and gold is a financial play.
Yeah.
But when you've got an inflation spike, again, they'll all lift initially, and then the industrials will fade. So copper will fade and probably hold up reasonably well. And then eventually silver will fade and track copper if the world goes pear. If we go into a recession, even gold sells off. And that surprises a lot of gold investors out there. I've shocked them all the time with that one. If we go into recession, you will sell your gold position. You have to cover your losses elsewhere, and no one's actually worried about inflation during a recession event. So that's the worst case scenario.
Yeah, and it's certainly not as much, but there's day 7 when you're putting out fires.
Yeah.
That you're sitting with that nice shiny thing that is right.
That's. I think I've seen you do that too, actually, Richard, on a trading desk. So,
Guilty.
Yeah. As the day set in. So
Yeah.
That's. Yeah, it's the last thing you're left with, and to let it go. But sometimes you have to.
Yeah.
So.
Right. Well, you mentioned copper there, so let's. Well, first of all, let's have a look at the whole space there. The guys are going to get that up for me. There it is. So the HGA 456. Now that, when you were on last time, was $5.40. So.
Yeah, I mean, thanks for saying I got the call right, but but that I was talking about the fact that it was completely unreasonable to expect that Trump would be a critical commodity input for the US economy. Yeah. Copper and so on. But you know, he's Trump. You don't know what he's going to do. But I was he backflipped completely out of it. And you know, in any other time, people would be investigated for a turnaround like that. And as a commodity analyst, I was fascinated by it because I've never seen price of a commodity trade so thoroughly tortured like they were in the months leading up to that, and how it's just gone back to where it was pre-April time. It's incredible.
And did you expect, because it traded basically $4.40 for about a week.
Yeah.
Did you expect it to go that low?
So talking to copper trading mates, they basically said, well, was, you know, the price level before he talked about tariffs. So you have to go back to, well, certainly before April, February, and they use the February time level as the benchmark, and they've just gone, all bets are off, we're just going back to that level. That's the benchmark we can work with. Okay. And they still seem to be building positions from around that level. So, and now it's, I think, at 460 copper. So, so it's now responding to rate change prospects this week. So we'll see how that plays out. But data, macro data being reported this week. So isms today. So the market's positioning to hopefully see, for them anyway, expecting data to come through confirm. That's what they're playing at the moment. If there's any, see a bit of, this is a choppy week for commodities, particularly for copper.
Yeah.
So.
How's that feeding into Glencore? Where do we sit with Glencore?
Well, poor old Glencore, you know, I feel sorry for those blokes. Lovely guys.
Tough, don't they?
They've just been kicked around all year. So in troubled times, as I was saying before, if you're mandated resources, rotate your money into high quality stocks. So Rio and BHP are your giant cash cows, and Glencore, the Anglo, would come under pressure. That's what history is over the last 10 years of trading. Yeah. And so they're struggling on that basis. Glencore's taking an extra hit because coal prices have come under a lot of pressure. But things are stabilising for Glencore because we've actually seen a recovery. It's across thermal and met coal, and they are So that'll put a floor under their equity performance. But still, the macro is a big problem for Glencore. That's what they're battling with. So, I'd be cautious about underperformer out of the diversified group year to date.
Can we just pop the chart of Glencore up, please? It's the biggest kicker if we get a prolonged stepping away from net zero. That's
story. So opposite of what I said. If things improve and the market stabilises on a shift in macro, I would expect a rotation out of quality stocks, Glencore and Anglo. So Glencore and Anglo will pop out of the diversified group.
More on the coal side of things, for example. If the
okay, so Trump leads the charge and says coal. Glencore's an obvious beneficiary.
Right.
Coal because Bungaler and it's trying to get rid of its met coal out. Everybody doesn't want them. And other beneficiaries would be all the coal pure, even New Hope, Shenhua, China Coal in China, and Bumi in Indonesia, and Peabody as well. So systems around the world feel a bit more comfortable about engaging coal-fired power gen systems. So a little bit, yeah. So
what do you think of that?
Yeah, so it's had a little bit of a bounce. It was stabilised around 70. That's about the marginal production for the industry. Then it rallied to 75. Have that up on the screen? Yes. So a lot of excitement, mainly from North American investors. We talked to a lot of those guys. The driver there this week is Canada. So they're the biggest producer after Kazatomprom, I think now.
Had an amazing run, didn't it?
Yeah. So quality company, almost vertically integrated because they do uranium mining conversion and they've got interests in power gen systems, nukes, in North America. They suddenly announced a closure of production troubles at their flagship operation, the McArthur facility. So global market's about 180 million pounds. The mined portion is about 140, and Cameco Good Day does about 20 million, 25, could do 30 million pounds a year. So all of it comes from two operations that they control, McArthur River and the Cigar Lake operations. They're claiming that McArthur River is struggling, and so instead to about 18 to 20 million pounds, apparently they're only going to get to about 14, 15 million.
Wow.
The market's so excited about that, but in actual fact, it's probably 1% of global supply. So it's probably not as big as people think. And I wrote a comment yesterday about it, got a lot of incoming grief from you don't understand it. And
they still say please?
Yeah, they did say please, and they're back from shooting, so they're extra. But yeah, I'd just be cautious on this one. Downside risk is limited at 7, but I need something more substantial to and maybe and react to build out in the they've actually funded that. If we get some more numbers on that, I'd get more interest in uranium. But at the moment, just
take me through Indonesia. I believe a few problems.
Yeah, it's a protest. Big deal for me because they're a big producer of thermal coal, obviously. So 40% of the world's thermal coal that's traded comes from that. and so obviously a lot of government revenues come from the royalties and trade flows of that material, and so it's not good that the government. So,
Right.
why are people protesting? Apparently, they're upset with very generous benefits that have been handed to parliamentarians there, and they're really angry. But it's a bit confusing because the Subianto government is very pro the community. They're actually rolling out some very expensive programs. One's basically free food for school kids, and that will be a very expensive program, and the mining industry is supposed to fund it.
Right.
So it's odd that one must be happy about that, but then the benefits to. I think there's obviously a political game being here.
Right.
But so far, no impact to mining, but it's a risk worth tracking. If the government has trouble sort of managing the disruptions that report into the supply flows, so that's probably one.
Definitely. Now, oil is the.
Yeah.
Well,
So prices. A lot of people are frustrated by the Saudi policy of delivering surpluses to this trade. So, so it's an almost 100 million barrel a year player in that. And right now they have the official view is the Saudis are delivering a surplus to the market to cap the price. And they're told that Kazakhstan them for producing an excess. If the Saudis produce a surplus in the market and bring the price down, Kazakhstan will have no choice but to reduce. So that theme is going around the market for it, but I think there's a political angle here. The US basically gave the Saudis a $140 million weapons package in May, and that policy started immediately after that. So,
Right.
So I think the Saudis are funded to deliver this surplus, and it just makes the US government look really good with the low oil price. So it's probably worth looking at events in the market outside of what we're actually being told in the news flow. As a commodity analyst, I'm intrigued by that because it reduces the cost of delivery of all other commodities, so it reduces the cost base,
Of course.
and makes it cheaper to get it to consumers. So 60 range.
And yeah, I was going to say, what do you think floor is?
Well, $60 a barrel. So I'd say think about 60 to 65. That's probably what they're happy with to hold for a short period of time.
Yeah.
And I'm talking the rest of this year, sort of thing. So,
Okay.
yeah.
Excellent. Right, Tom Price from Panmure Liberum. Thank you so much.
Thank you for having me in this wonderful room. Oh, okay. Cheers.
Or a ticket to the Ashes.
Ah,
Unfortunately,
oh, here we go.
official sponsor of the English team.
Well, good luck with that.
Tom Price, thank you very much. We will see you after the break in 1 minute for all sessions open after their Labour Day holiday. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices,
Time of the day, and it is the all sessions. We are off to the races, so let's get the chart up for you. Here we are, taking out, still early, but we how it's moving. Of course, related to the alternative medicines. Well, the Best Buy down 1.8%. Pounding head down AI, the all that voice assist that you're having in your house or in your car of 8% there. Reddit is also down 1.4%. Computing stocks up lower. Let's have the winners list. Don't pay attention, which means it hasn't quite shaken out yet. But we have got on the winners list, NEO up 2% there, and also MicroStrategy up. Eric Mining also 5% now, and Novo Nordisk, the Novos up is down, so that's interesting. Taking a look at some of the ones that mean darling of 8%. I just also want to check. Monkey Man, are you here? Good morning to all of you that has just joined. Boise, have a great time. If you are listening to us whilst packing for Norway, you can always patch in from there, but do have a good holiday. We've got Tesla, checking in on Tesla for you because of 8%. Just reading out move because it comes as Tesla says that it's got around 600 orders. And Tesla now planning to ship between 350 to 500 cars to India this year. That is according to Bloomberg. Let's have a look at my favorite ticker time, MRNA, because it's been requested, I've been told in my ear. So here we are. Let's just have a look there to see whether we have something different, but no, not. Vaccine, I hear you asking me. Yes, unbeknownst to all of us, thank like Madonna, still producing COVID-19 who are probably immunocompromised or a lot older. But this particular medicine can be used from those aged through to 64. Taking a look elsewhere in equities space. Many of you here for a week off heard me talk about time as well, and it looks like it could potentially have a bit of, because many of these consumer names, these big still suffering and saying the outlook remains difficult, and there will still be an emphasis on supporting more cost-effective parts of their offerings. All these companies, including Walmart as well, looking to try and drive revenue from other areas. With Walmart, it's their advertising, and also they're connecting sellers to buyers through their vast network. So that leaves me to our upcoming session. We're going to have Luke Moore up next. Rich, of course, just a very quick update on the markets as well. Europe, of course, starting off the week on a bit of a somber mood with the US close today. But as you can see here, we're still seeing that slide wait mood panning out. If you look at my chart there, most investors and traders are going to take big positions, especially when we've got jobs numbers out later this week. We've also, of course, got some other earnings still to come, like Salesforce, and looking at some of the big. We've got Nestle. You heard me say earlier that for these companies, there's been a lot of data on the impact of CEO misdemeanors, and we saw Nestle down some 3% earlier. They have actually, it has come back slightly now, as you can see there. Let's have a look at 5 minutes for you. There we have it. It has come back since that immediate impact. Shock departure of Nestle's CEO, of course, more for the maker of Kit Kat. And you can see here on the weekly chart, it has already had a very tumultuous time and been on a downtrend since the back end of 2021. Right, we've got Luke up next to talk about all, but also luxury. We know more likes a bit of luxury, so stay tuned for that.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. You've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account, join the conversation, and be inspired to make moves. If you're looking for flexible ways to trade financial markets, whether you're or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, Forex and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Welcome to the show, and of course, embracing our new studio here.
It's
What do you think
nice.
so far?
There's space.
Huge.
It's clearly the same size, but
Yes.
you've got so much more space because we've cleared out all the
Clutter.
nonsense that was there.
Yeah.
But yeah, it's great. It's looking really, really good. It's got that new car smell.
It does.
It's got that smell of tidy. We've cleaned up a little bit. So
Yeah.
I'm excited for what you guys can do in here. It's
Yeah.
it's a good time.
As well, for those of you watching, we look well lit. You are sat listening to us, but actually we're almost in like twilight cocktail light, aren't we?
Yeah, it is. Yeah, I feel like it's definitely not. What is it? 9:15.
Yeah.
It's too early to have cocktails.
Oh, but
think.
you know, it's too early. But the mood lighting does mean that Ange's astigmatism as well is not, you know, no glare, which is great.
I can tell. Well, I should have cleaned my glasses before I came on because I don't know if you can see, but I can't see it.
It's also a special day for you.
It is.
Whilst markets are tanking
tanking.
for the FTSE and the DAX, it's not tanking people, but rather having a bit of a rough early morning. It is anniversary.
Second wedding anniversary. Yes, it is. Yeah. So, taking Mrs. Moore out for a nice lunch this afternoon. Looking forward to it.
Lovely.
So, yeah, the markets unfortunately are not having an anniversary. They're coming back from the US holidays, and everything's.
I know. Look at the DAX. Look at the DAX. Down more than 1%.
Should we have a little look at this on?
Yeah, Luke's
in terms of
driving
the prices.
today.
Yeah, I am driving, and I need to get my DAX charts up in here.
So Nestle as well weighing because CEO Laurent, but we have this you know, pretty much modern down, or cautiously down, shall we call it, because you know, FTSE also down, wider Swiss blue chip index also down. You know, the Korean hit by this broker action is.
It's been a weak start. I mean, I'm this morning and talking to some clients, and it's the UK 30-year gilts that seems to have freaked everybody out. So gilts this morning hit a high. So the low curve and can't change 5.6, 3 or 4 basis points since. I've got a little thread here that I think is putting this into a little context. Now, we're big fans of using information that's already out there for our retail, and I could not recommend this Twitter account. American chap who writes an investment letter, but what he does really well, in my bringing this macro to the forefront. Okay, and put this in context. You know, you can see the huge move that we've seen up in the long end of UK bonds. Right, our cost of borrowing is skyrocketing. Right, and we've had a deficit. This isn't something that's unique to the UK, but we're certainly feeling the pain on it now. Where it starts to apart. So what we have here is the Office for Borrowing, the OBR, the statistics, is proposing that our deficit is going to narrow. So the government revenue completely take off. And this is what we're seeing play out in real time this morning. So it's been coming, there's a trader that I can't remember their name, but one of the things I used to listen to is risk happens slowly and then all at once. And that's what you're seeing here.
Like this, really.
A little bit like buses. Yeah, a little bit like buses. And then this continues. So now what they're saying is the reason why these are is exactly here. So similar to the UK, to the US, is going to skyrocket. And that's up to 270% of GDP by 2073. Now, if you think about debt levels and you think about the economy, typically if you get anywhere near 120, 125, that means you're probably going to have some form of default risk on your debt. It just is how it out. So we're now forecasting 40 years in advance, 45, 50 years in advance, that we're going to be at 270. That's not good, bruv. That's not good.
It's not.
And that's really concerning the market this morning.
And what is interesting as well is that, in fact, the BBC had a doco about this right for the UK has been happening for such a long time, right? Like since the 30s, 40s, 50s. It's just been getting bigger and bigger. And almost, it looks, if you look at the chart, someone just stepped on the gas pedal post-COVID, right? And so we are now at levels that are concerning market. We had, of course, the chat, Mervyn, coming on saying as well that it's double the amount of Germany. I can't see the chat from here, but we'll put it up in a.
So we've just jumped back onto this thread, and in terms of showing kind of why it's happening all of a sudden. So our growth flatlined in Q3 of last year. And it's just compounding the problems. So yeah, it's not looking particularly pretty here in the UK. 5.66%. I was trying to find out what other nations, probably pop the chart, guys. What other nations have got interest rates like that? I didn't get a chance to search it, but I'm going to use my favourite AI robot, Perplexity, to ask them the question in real time. Which are the
This is pressure, right? Because costs, and we've got a weak, sluggish economy. Clearly, if you wanted to see any signals that support this, look no further than the which reflect this bearish sentiment. We've also as well for GBP puts over calls. So we're looking at this perfect storm potentially emerging.
Yeah, and this is it. Risk happens slowly and then all at once. Okay, this time last week, I was talking. Where are we? Down 0.9%. The FTSE's down 0.3%, so that's bounced back a little bit off its lows. Cable is down a whole 1%, but the French situation with the potential for the government to be dissolved, there's when you start to think about bonds, and I'm certainly no bond expert, but you often talk about the spreads. So at what rate would a German Bund trade above and versus the UK? And the problem is all the spreads are widening, and so you're seeing a divergence in European economies, and that's never good. You would expect a kind of similar European area. Of course, now we're not in the EU to be performing similarly, but the whack. Germany have its own problem. To work straight. No, it's not. For those who are watching, We're going to try again. Ish.
Yeah,
What you can see there is we've got FTSE 100 has been recently shorted, followed by the S&P 500. So IG's top 100 traders are using this opportunity to take risk on the board and take a short-term short. Yeah, I don't think that's necessarily looking. But if you can find onto the explores where we put all of our content, including stream in real time. So hopefully you're already watching. And then navigate down to top 100 traders. So we're constantly looking at what IG's best clients are doing in as as we can. They are buying oil. Oil's up 1% today. They are buying. They're also recently long United Health, MicroStrategy, and the China A50, interestingly enough.
Interesting. Hey, we have seen the Hang Seng gather some win recently. But it's interesting to talk about this bond thing, because when I was on holiday last week, I did note that the gold preceded all the noise that came from Trump's attacks on the Federal Reserve and everything, right?
Well, gold's just...
Yeah, and I'm wondering whether this uncertainty now brewing in the bond markets is something to do with that unwinding of that great march higher that we've seen in the FTSE in the...
Yeah, perhaps. Look, I think probably a little bit more dollar sensitive than looking specifically at the UK.
Yeah, but just that uncertainty of things, you know,
of course,
starting
of course.
to brew the bond market.
I mean, it's peaked. I mean, I came into reports of spot gold being around kind of 3.5. Let's just have a quick look at this. It's really pulled back so far this morning. We've really pulled back. We did see that move through 3.5, and in low liquidity throughout the summer, we've just been moving higher and higher and higher. Here you go. You can just see this now. I'm looking at a 15-minute chart there with a 200 period moving average, and we've barely kissed it all day. We just keep higher and higher and higher. So let's we used we were looking at spot gold, we were looking at spot silver. I was on the late shift yesterday, so that's what people were talking to us about. But
yeah, finally, high silver, right?
Yes, it seems to be a little bit lower so far this morning, and I'll pop that up on here. And again, we're looking at the 15-minute horizon, 200-day moving average, and yeah, it's following a similar pattern to gold. It's been up, and it's. I personally, need to kind of look at any real short trades here. Does this pull back now once the US assess their portfolio, potentially see this move as a reason to add some hedges? Perhaps.
I think maybe.
I find it tricky to read.
It's also tricky to read before that jobs number, right? And we've got a lot of macro data coming out. I'm monitoring gold as well, because you saw earlier on my chart, if we do breach that, then we could potentially march slightly higher. But if we retest that and it comes off, then we could potentially move back to the levels that we saw around June, July time. If you go out to the daily chart there.
Oh, I think these must have been some golden lines that I put on there. Inspired by...
yes, the golden line. So
golden lines, yeah. So what are we saying?
Duke's driving off history and 506. If we don't kind of get past the level, then perhaps it's all. Yeah.
And I think for that to happen, you need to see a little bit of dollar. I think you probably need to see the equities have a bit of a move as well. But look, I mean, what's this, 1 to almost in a straight line for what's that, 10 sessions potentially. That's not a good sign.
No, and that's right. So 1 is tentative in the world of technicals. 2 gives you more assurance, but actually there's no confirmation until a 3rd. 3 times a lady.
Is that it? Once, twice, 3 times a lady?
Yeah.
Let's just have a quick look and
Right.
see how.
Well, Luke is looking at his chart and getting that up. Sterling also watching that because it's coming off a 2-week high that was touched on Monday. Dollar also bouncing off that low as we see gold near that record high.
Yeah. So just looking here, just at the because of this move in the long, seeing those interest rate sensitive plays come back in, it seems to be a defensive day. So your AstraZenecas, your BPs, your Rios are being bought up in the UK. Everything else looks quite weak. Specifically, I mean, look at Vodafone down there, down at 85. AMD results, which looks okay. They've just been getting killed. SMCI, another half. But then let's look at the majors. Amazon's down 0.9, Meta down 0.89, Alphabet down 7, Tesla. Interestingly, Tesla put on their Twitter account last night, Master Plan Volume 4, which I thought was an interesting read, talking much more about the world of physical AI. So if anyone's out there that wants to have a little read on that story, go to
Agentics AI.
It's more about physical AI and the kind of case for robotics. It wasn't news, it was just kind of tying things together. But ahead of their results, which I believe are next week, it's just an interesting to know.
We follow, Tesla investors out in LA, and the whole premise is that whole robotaxi revenues will drive and pay for the humanoid, project.
Yeah, my cousin's in LA at the moment, and he's currently driving around in a Waymo.
Ah, what is she?
Weird.
It is weird.
She's finding it really, really strange that she's driving around and there's no driver in. It's very odd.
I've heard good the voice assist. Like, has she tried to ask Waymo to wind down the window?
I don't know. I haven't got that far now.
You can go, Waymo, wind down the window and put on massage.
Ooh, very nice.
I've also read that they're trying to fix a quirk that if you have a so if your cousin is driving and other cars are there, so Luke's on the other side of the roundabout, wouldn't be a problem because the Waymo would just watch the other random cars and then decide when to come out onto the roundabout. However, if 4 other Waymos appear and your Waymo's trying to get out,
they're all just there's that meme, isn't there, of like 3 cowboys pointing at each other.
Yeah, they're just waiting, and so you end up because everyone is waiting for the next Waymo to come out onto the roundabout. So they're trying to fix that at the moment.
Fascinating. I tell you what, one thing I want to show you that I was looking at and I've used a few times recently. I don't know if you and I have spoken about it on the show, is TradingView. Have you seen TradingView?
Yes, not recently though. We used to have it quite a bit with.
And of course,
the heat map.
You can log into your IG account and broker through TradingView, which is why it's worth discussing this. But they've got a fantastic heat map. So I'm specifically looking at the FTSE 100 here. You can clearly see at the bottom there, the energy sectors. We know oil's for Shell and BP. We know that there's some sensitivity going on with the long end of pressures. Lenders are under pressures there on the top left-hand corner. Your more staple companies, the AstraZenecas of this world, the GSKs, they're having a fairly green day.
The divvy stocks.
Durables. The consumer durables. BAT's down 2%. Something specific on news flow that I haven't seen, but it just gives you a nice picture of the market. Probably something we could probably do a little bit more on this show.
It's a nice snapshot, isn't it?
It's a nice snapshot, but also what it's doing is it's trying to weight the cap. Of course, AstraZeneca being up 0.6 and Vodafone being down 0.1.
You know what I also love about this heat map is that you're proving my defensive selection is working. Diversification and just I've given my cable of power to Lou. No, it's fine, it's fine. Yeah, so I've got BP, I've got Shell.
Yep.
So let's whack up to see whether they align with.
So we've got BP and where's that disappearing to? We've got
Hey!
1.2.
Shell,
Yep.
AstraZeneca.
AstraZeneca at 0.6.
Ah, GSK. Did we see a GSK there?
GSK at 0.7.
Yes. Unilever.
Unilever at 1.4.
HSBC.
At. Relics, where are we?
Oh, maybe no relics.
Relic.
Rio Tinto.
Here in non-energy at 0.13.
Yay.
There you go, relics. Flat on the day. So you've got a fair. Look, September's a bad month seasonally.
Yes, seasonally it's always a poor month.
Real dressing towards the end of the tax report lag even further. Being the weakest. So, you know, we're going into September a little bit bumpy, right? First proper trading day. Yesterday wasn't because everything was closed in the States, nothing really going on. So yeah. Keep an eye on top traders.
Hack for you guys and girls have with some of the UK listed gold miners, you know, first. It tends to be, it doesn't always hold true, but there tends to be a here Axel always say, then pay attention to the Canadian gold miners, you know, that might open a bit later. For example, London. So always have separate watch lists if you trade the sector or invest in it often, because there's always, I always say to people who are, you know, new or beginning, don't boat, because you can always trade the bounce back, you can trace a retracement, or you can.
Yeah. I mean, I personally think your zone of confidence. I'm just popping the shares back up on there, just while we're talking about this. I would always try to simplify if possible. Having all these different companies is fantastic, but then it just means you've got to track more things, right? If you're going to do that, try and bring. So, you know, having Meta, I'll go and buy Tesla, that's not diversification. Bring in some of those defensive names. If you are nearing a top and you want to reduce your exposure to some of these high beta names, go into October, which is normally a few weeks' time.
September.
Are we just in the start of September?
Also, as Luke rightly said, make sure you are aware of diversifying properly. You know, some of us, and I've known many people to say, oh, I've diversified, I've gone to this ETF or this tracker, but actually dive a bit deeper, you know, all the same constituents that you have anyway in your tech names, or, you know, for example, in the FTSE. So just be aware. Some of the apps I've seen recently, they've got this fancy AI kind of using that app to diversify. So I had a really strange email AI the other day. Dear Angeline, you're too heavy on uranium. Please diversify. That's really, and
well, I suppose when you get into that world of advice, right?
Yeah.
I mean, that could be something really interesting for us to explore. 50 years worth of client trading data. I'd wonder how well we can lean into that. Yeah, I mean, you and I have spoken about uranium before, and it's going nowhere.
It's in a digestion phase.
It
Mine is a
yeah.
long
Too
term.
early.
Long term. Yes, you need to wait.
Yeah.
I think it's starting to in the last week whilst I was on holiday.
Yeah.
So if you look at Sprott, uranium miners.
We'll look at Sprott while we're here.
Yeah, they've started coming a bit higher. Luke's driving.
Ooh. Well, the physical uranium.
Sprott
Yeah.
uranium miners. Yeah.
Doing okay, actually.
See, so it
So
started coming.
Starting off at the start of the base, and looks like it's performing quite well. So it'll be interesting to see how they open up today. In fact, let me see if I can get anything pre-market on them. I don't think I can.
Elsewhere. You know, uranium is a longer term play, right? It's always going to be a longer term, 5-10 years. So
Yeah,
you
but-
need to be patient.
Yes, I'm very impatient, and it's whether or not you can see your alphabet as my kind of AI play, and am I going to get more of a return on my alphabet position? But yeah, I'm impatient. Start selling more cover.
Of course, those of you in the space will know that uranium prices, was cuckoo bananas in the last year or so. So there was always going to be a period of consolidation or digestion before, because you don't have a continued move up. And I think we are coming to the end of that, hopefully the end of that digestion phase, because if you put up similar trend there to the Sprott one as well, it has come off and retraced a bit, but then moving higher around
I've effectively misallocated the whole thing under the same theme. So it's a big lesson, really kind of knowing and understanding what's attracting the capital at the moment. The builders are attracting the capital because we're almost too early to buy the fuel. So therefore, buy the builders that are receiving the money and being able to contribute.
picks and shovels.
Buy the picks and shovels. Classic, do you buy gold or do you buy the gold miners, right? Miners have an earnings season. They have you get more bang for your performing well, but they're going to be sensitive to the price. You've got exposure to the fuel price in the uranium example, or the gold price itself. But yes, in this example, pays to know what you're buying, really.
We're running out of time. I'm hearing in my ear, but we've got, of course, just a quick overview of some of the movers and shakers, seeing a bit of downside, the DAX, of course, the FTSE as well. Stocks falling to the lowest. Also, some weakness, luxury.
Queuing and LVMH got upgraded today, I believe.
Yeah, so upgraded, had a positive action, and I think Hermes got downgraded.
So I saw LVMH upgraded to a buy with a 625 price target. Kering upgraded to buy with a price target, and it was downgraded to a hold.
Yeah. Or the bottom, and on that, the head of Martin Webb, coming up next.
Nice.
Right, welcome back everybody. Ahead of having the CEO of Smarter Web Company on, I wanted to really break it down on explaining the model of Bitcoin treasury companies, right? This isn't just Smarter Web. This, whether it's MetaPlanet, to be able to get your all you need to know is that, yes, I can buy 3 apples today, the same as I can invest £10,000 in Bitcoin, or I invest in an apple tree. And if I invest in the apple tree, it's only got 1 apple, but I'm investing in a tree that produces more apples every time somebody else invests in it. Every time somebody waters the tree, a new branch grows and get more apples over time, forever more. As long as it trades at a premium to its MNAV, then you have more apples grow on the tree, and over time, then 5 apples, 6 apples, 7 apples, 8 apples. Your original that you bought, the 3 of them, if you don't invest in the tree, if you just invest in Bitcoin, those can up in value, that's fine. But you'll never have more. You'll only ever have 3 apples. If you invest in an apple tree, time you can grow more and more and more every time that the tree is watered. Andrew does a capital raising, an equity raising, or these smarter convertible bonds. And that is what we are going to speak to him about today. Well, very happy to invite back Andrew Webley, the CEO of Smarter. How are you doing, Andrew? It's been, I think, 2 months since you came into the studio. Longest 2 months of your life?
Certainly the best 2 months of my life. Yeah, it seems like a lifetime ago that I came into your studio. Yeah, a real lifetime ago.
That's right, and the stock was at 28 pence. Did you own?
We did effectively private placements. So up till now and into the future, we can raise capital through equity raising, private placements, whether that's from retail investors, high net worth investors, or institutional placements. And then what we did is
now that updates people on you almost don't notice it because it's just how I think of it. And then yeah, this third one yesterday, if we're going to stick with the apples theme, because Bitcoin does a little bit more complicated in people's minds, but the worst case scenario is people have given you 20 instantaneously go and buy a load of apples, and the very worst thing that can happen to the company is have to give the apples back.
Well, yeah, but we keep 2% of the apples as well. So from the investor's point of view, they're sort of risking 2% of their apples to make a greater return. And from the business's point of view, we're hoping that it converts, the apples convert into equity, and then they become our apples. And it's a beneficial way of raising equity. So as an example, because the premium that they pay, the conversion price they pay is only 5% above the market price at the time, it's better to the tune of 5% for my shareholders that I can do it in that way if it converts. So and there's no interest or anything like that on it. It's 0% interest from a really, really credible investor. And that was the other thing that everyone started to understand the Smarter Convert yesterday. And I think over the next few days, they'll understand it and they'll see it how I see it.
Yeah.
But the really cool moment also yesterday was it first, public name that's become an institutional investor. Obviously, we've got institutional investors, but this is the first capital raising that we've done where we've been able to name the institutional investor, and they're really good people, so that's great.
And so, can we talk about how did they come to you, or I know that you've been working on it for weeks. Is it did you start off with a seed and then you kind of negotiated on how it should look, or was it simple to come up with?
Yeah, so I think about everything all the time in terms of ways that we can generate capital and all of the other aspects of the business, because ways it's very simple, in some way there's a lot to do. So we think about all these things, and we've got lots of ideas of different things we'll do in the future. Now, I met with Michael Saylor from Strategy a couple of weeks ago in London, and we had a good chat about what we should be doing. But clearly, his business is way bigger than ours at the moment.
So far.
The thing that I'm slightly worried about is exposing the business to any debt. So I'm quite cautious. I love Bitcoin. I've been investing in it for almost 10 years. I believe it's the best asset in the world. But my job as the CEO of the company that I set up 15 years ago, we listed this year, is to see that the company is very, very successful for the medium to long term. So in the short term, we do have to be careful about debt. So we've had this idea, and we've had loads of people suggest different things for the last couple of months, and some of those things are good, some of them not so good. So the thing that I couldn't get my head around until very, very recently, let's say a week ago, is exactly how I could do this thing so that I was 100% happy to do it, because I don't want to do it if there's any doubt. That's not good enough. So that's why the term, in some ways, very, very simple, in my opinion, very, very clean, but also beneficial for everyone involved, in my opinion. So it's just getting the terms right, So in any relationship, you have to make sure that the thing that you're doing together works for everyone. Otherwise, it won't work long term. It's as simple as that. So what I didn't want a deal that was, lopsided for the investor or for the company, because it's not going to work for the long term. And we want to sell a lot of this particular instrument. Right. So it just took a bit of time to get it right. And I'm really pleased with it. There's a couple of small tweaks that we might make for future rounds.
Okay.
Maybe we'll increase the premium that they have to pay. Maybe the duration from 12 months to 24 months. We want it to be quite short term.
Yeah, that was the thing that struck out to me, was 12 months is relatively short in the life. So that definitely, had it been 24 months, I would feel a little bit more comfortable even. I like it as a shareholder. But 24 months it just seems like a decision has to be made relatively soon, because we know how time flies, don't we?
Yeah, well, that's why it's priced as it's priced. So their conversion price is very, very close to the current market. When it gets into the second half of the instrument, so the second 6 months, I've got the right to force them to convert if it's 50% above that. If you look at the last month or two, you can see, providing you believe in what we're doing as a company, you can see how we'll quite comfortably get past that level. So that's why the 12 months is, sort of absolutely fine in my mind.
Yeah.
And then you've also got to think about the fact that worst case scenario, and I put this in the announcement as well, because I wanted to put it in simple terms, worst case, best case scenarios. Worst case scenario, we give the Bitcoin, and importantly, the $21 million that we've had come into the company, if Bitcoin falls in value, we give back the $21 million of Bitcoin that we bought with it. So we're not exposed to the volatility. In the short term, in 1 year, I don't think that you would necessarily want to structure it like that if it was based on fiat. But of course, if it was based on fiat, there would be other complications, or there might be a small premium that you have to pay on the interest, and things like that. So, I genuinely believe that it's a fantastic thing for the company. And I think there's going to be a lot of interest from other people. But like everything else that we'll do, we'll probably sell a lot of it, but we'll also sell it alongside our other activities and cap it to approximately 30%. But if you go back to those three things that we've used, the placements, the ATM, now Smarter Convert, any investor needs to step back and look at the three of them together. So they all work together to make the company bigger, again, in my opinion.
Exactly. It's almost like who are scared about paying an MNAV premium, and their thought process is, right, why don't I just take the money and invest in Bitcoin? Well, this is doing that. This is giving them a chance to buy convertible bonds, which is basically buying Bitcoin minus 2% with an upside call option on the Smarter Web company.
Yeah, 100%. And, obviously we've spoken to other people that are interested in this particular product already. And in the short time, i.e. 24 hours since the RNS came out, we've had people get in touch with us also expressing an interest as well.
Okay.
So there's a lot of people, there's a lot of institutions out there that believe in Bitcoin like I do. And there's a lot of people out there that have got a lot of Bitcoin. And we always say, what is better than Bitcoin? Well, the only thing in our opinion, Bitcoin is compound Bitcoin, which effectively we're giving people some exposure to something like that.
Yeah.
So yeah, I think it's a great solution for everyone, the shareholders, the new investors, and the company.
So let's take a look at the website, this great treasury analytics page that you put together. So Bitcoin hold, we see there 2050. We see the NAV now up above 200 million sterling, which is huge. Now, does that include 21 million? And it includes the 8 million that you raised the other day, but it does not include any updated ATM amount.
No, so that's almost right. So the figures on our dashboard, zoom up to the top where it says shares in issue and the market cap, we've put that in as a diluted figure. So what we did yesterday morning is for the shares in issue, we added in the shares that would potentially be issued if the Smarter converts, just to give people as much transparency and as realistic a figure as they should be using if they're looking at our company. So then if you look at the NAV, the 200 million approximately figure, and it's worth saying when we're talking about our NAV of 200 million pounds approximately, that we don't have any debt as a business, zero debt. If you're not counting as a debt, because it's kind of debt, kind of isn't debt. So 200 million pounds there. And then the most exciting thing for me at the moment is if we look to the right of there and we look at the NAV, you can see that if you believe in the Bitcoin treasury model, which I do, obviously, you can see that, based on the last few months, we look quite compelling at that point. And you can compare that to things like Metaplanet, Strategy, Capital B, which was formerly called the Blockchain Group in Paris, all the Bitcoin treasury companies that I actually hold that I really like.
Yeah.
And you can see that it's pretty in what we're doing.
That's right. So back to where you were on the 1st of May. So in terms of, if we wanted to think of this like a PE ratio, and so cheap to invest in on a valuation basis, from the 1st of May, which that is really interesting. And it also feels to me safer. The easiness when we were up at double digits, even 15 times MNAV, that was it felt like almost like a meme stock, the way people were treating it at that stage. But now it feels you've managed to bring it back to compelling, serious business that, as you say, you're finding new sources of liquidity. Because not only did you start with the equity offerings, US, and it's got the US listing, then the ATM, then this convert. Are there any other ones that are in the public domain that you can look forward to this new pool of liquidity potential?
We also managed to get in place a Frankfurt line of stock, because we've got quite a big global base of investors, not just UK investors. I live in the UK. We're a UK company, but we are as my daughter says, a global phenomenon, which she can say the word better than me, actually. And she's only 12. you know, so we do have the Frankfurt line of stock. We do have some other ideas of what we'll be doing in the not too distant future, but I can't really talk about that one.
Certainly.
Going back to the point about the MNAV and the history and where we're at the, like this is just markets, as you know, Rich.
Yeah.
You know, when things are cheap, you know, less people, you know, creates opportunities and things. You know, I've increased my holding in MetaPlanet this week. I've increased my holding in the blockchain group last week, which is now called. You know, I fairly recently increased my holding in the Smarter Web company at approximately 100 times higher than when we listed the business.
Yeah.
I put in approximately £100,000 of my own cash into the company. I think it's approximately the share price at the moment, maybe a bit higher. So, you know, it's just how it goes. You know, we're in August at the moment. We're busier than ever, but the is in our life as a public company because it's August. So discrepancies. And all I can do as the CEO is I can keep doing what we're doing. You know, if we look at just this week alone, you know, we've announced a capital raise on Monday. We've announced Smarter Convert on Wednesday. Today is Thursday. And we'll have to wait and see.
What do you think the effect will be if Bitcoin?
So if it goes down a lot, which is not what I believe, then clearly our shares are going to take a hit because I don't believe in pounds. So I believe in Bitcoin. Hold the assets in our business as Bitcoin rather than, you know, GBP or dollars or euros or anything. That's my life for almost 10 years, and that's how we run the business. So obviously, if Bitcoin absolutely bombs out, our shares are going to suffer. It's as simple as that. Now, over the long term, we're not going to sell the Bitcoin. You know, we're an operating business that's been profitable for 15 years. So I think the worst case scenario there is potentially it makes it harder to raise additional capital, you know, to keep the flywheel going.
Yeah.
But then at some point, if we look back, you know, 16 years of Bitcoin, you know, historically, when it's had a correction, it's always then improved and it's gone considerably higher. You know, it's the best performing asset over that time period. Been off the top of my head, 3 bad years in that time period, 3, you know, which is awesome for any type of asset. So, you know, if Bitcoin has a bad time in the short term, it will be a buying opportunity for people. You know, that's just how it goes. But we believe that we'll go into the millions and millions and millions and will go up forever.
Yeah.
But obviously not everyone shares that opinion, which is fine.
Certainly. How do retail get involved in this corporate bond? You know, could there be a chance in the future that there'll be some kind of retail offer?
High net worth individual or a professional investor, then potentially you could contact the company and, you know, we could involve you in a future round of this. So that's certainly possible if you meet the FCA criteria in the UK or the equivalent in the Europe, etc. Longer term, and this goes back to my chat with Saylor the other day, you know, we hope and we are aiming to have products like Strategy have got in the States. So in the States, I think it was a week, Strategy have done a preferred share, which is actually the most successful IPO in the States this year. They raised approximately, I think it was $2.5 billion in one of these additional products. For the current size that we're at, that doesn't make sense to have those products, which are quite similar to Smarter Convert. But, you know, I'm not going to want anyone to hold me to it, but in a year, 2 years, as an example, rough timeline, you know, hopefully we'll have those similar products alongside everything else that we do. So yeah, there's options for people.
Fantastic. Well, it's always great to remind everybody it's on the Aquis exchange. Traditionally has been a little bit more volatile, known as being risky than other stocks, and capital is at risk And yeah, it's making sure that people get their head around why the stock trades at a premium to its net asset value is the most important part of education. Yeah, thanks for helping us out with that.
No problem. See you soon, yeah?
See you soon, Andrew. Thank you.
Welcome back to Tasty Live. I am Dylan Radigan. As you can see on the screen, I'm joined by another special guest. Bill Fleckenstein from Fleckenstein Capital joins us from his headquarters in Seattle. If you're not familiar with Bill, you'll become familiar with him over the next 55 minutes. But just to give you a context for how important he is for me, as a journalist at the peak of the financial crisis, I was talking to 5 people every day, or maybe not every day, but most days, off the record, or at least off camera. One of them was in the Treasury Department. One of them was, actually 2 of them were in the Treasury Department. One of them is now a Fed governor. Another one became the head of the SEC. Another one was Carl Icahn, who was managing, whatever, 60 odd billion. Another was a gentleman who was one of the largest oil traders in the world. And then the man in front of you, Bill Fleckenstein, who is, in my opinion, the most intelligent, well-informed point of view on rates, the dollar, and markets that exists in this world, and doesn't do a lot of talking, which is probably the first sign that he actually is humble enough to know that he doesn't know a lot of the time, and so he just worries about trying to do things. I had Guy Adami here the other day, Bill, and I was just saying, like, the first sign of sort of quality is if you're willing to admit you don't know. So anyway, it's nice to see you. Thanks for coming out and making a rare public appearance.
Well, it's even better to see you, and there's no way I can live up to that billing, but at least I'll try not to fall on my face.
Well, I mean, I think it's important just contextually, because you and I were friendly before the financial crisis. We really became friends during the financial crisis because of the sort of pressure of that situation and mutual sort of interest in navigating it. And during that entire time, you were not alone in saying this, but I'd say, Bill, how do you solve this? And you'd say, well, you need a reset. You need to do a full reset. And I'd be like, well, what does a reset mean? And all these things. And then they would come up, they would do TARP this, or the commercial paper funding facility that, or the layers of things. And you'd say, oh, well, they're kicking the can, they're kicking the can, they're kicking the can.
And they did.
And they kicked the can.
That's all they did. That's all they did.
All they did was kick that. That's exactly where I'm going. So they didn't do anything structurally. They didn't they didn't deal with the leverage. They didn't deal with too big to fail. They didn't deal with governance. They didn't deal with anything. They just kicked the can. My opinion is that both the emergence of Donald Trump as a political force, and for that matter, the support of Bernie Sanders as a political force, was largely fueled by the unresolved resentment of the political alienation from that can kicking. And I don't want to sort of not expecting you to sort of wade into the political discussion, obviously, but I am curious, do you think it's incorrect to connect the way that the financial crisis was resolved with the increase in political extremism and frustration in the country since?
Well, I think for sure there is a connection, because there's a lot of frustration. I'm going to leave out the extreme politics.
Okay.
I'm going to talk about how the economic and financial pieces of the equation work through the average person, and that may affect their political affiliation because of who they think might help them.
Okay.
So in the financial crisis, what we did not get was, we did not hold anyone really accountable for the things that they did wrong. You could take a look at many of these CEOs who signed financial statements, which in hindsight were fraudulent because of the SIVs off the special investment vehicles, where they held a lot of that garbage off balance sheet, and they didn't get prosecuted. And it seemed like the bailout was for Wall Street. And so if you weren't part of that club, you had to feel a little resentment from it. Now, the truth of the matter is because the Federal Reserve did such a bad job of regulating the institutions that they allowed to merge, the banks that they allowed to merge with brokerage firms after they repealed Glass-Steagall, thanks to Greenspan's lead, the Fed was supposed to regulate those big behemoths. They did Zippo, right? They didn't catch any of that stuff. And then, of course, they came with QE and other things that have led to other things. But they couldn't let the financial system fail. So it got to the point where they had to stop that. But then they never used the crisis to solve other issues, like the fact that the budget deficit was going to lead to these kind of problems, which, of course, got accelerated in the last 15 years. And the Federal Reserve became even a bigger accomplice in terms of being able to allow you to kick the can down the road from a financial, like a budget deficit and national debt standpoint. So if I was on the outside looking in and paid kind of attention, I'd think, well, God, these guys on Wall Street, they get away with murder. And to some degree, it's true. I mean, not everybody who is a financial operator is in the privileged class or gets the extra help that the Wall Street got on that bailout. But I'm for sure people have to feel frustrated. And then when you look at what the precedent was, and we had all these QEs since then, and the really poor job that Powell did in terms of allowing way too much money to be printed for way too long and rationalizing inflation. Now you've taken that and you've angered a whole nother group of people, and you've given younger people, I think, a sense that they can never quite get there. They don't have the same sense of optimism that I probably had in my 20s and early 30s because of what's happened. And that's led to a lot more speculation in the crypto world and with 0 days expiration options and all that stuff. So this whole ball of financial speculation and frustration. One last thing about, and then I'll let you get a word in edgewise.
No, this is I wanted to start where we left off. It's been 15 years, so you can take
right. So the piece that I think is particularly pernicious is that when they came with all of the QE and that hit during the COVID lockdowns and disruptions, the Fed tried to pawn the fact, well, this price hike is transitory. And what they meant to say is, even though things went up, depending on what item, let's say they went up 50 to 100%, the Fed meant that the next year wasn't going to be quite that high. Well,
but still, a block of cheddar cheese is $10 and no longer $5 or whatever.
Exactly. And so even if it only goes up by the proscribed 2%, it's still 50 or 100% higher. And that price is there every day. And that changes people's psychology. So then they begin to become more sensitized to it. And now the Federal Reserve, I don't think, has much credibility on this topic. It's a debate amongst very smart people I know who would disagree with me about this. But the inflation psychology genie is out of the bottle. And that was the hard thing for Volcker to break. That's why it took as long as it did in the 80s to finally break that psychology. And people don't understand how hard it will be to unwind that once again. I don't think they can. I think they've picked the path of let's run. Now I'm saying the administration investment, they've picked the path of we're going to run the economy hot and try to inflate our way past the debt. Mm-hmm. So that's 10 years in 8 minutes.
Yeah, well, I mean, but it takes us to present time. We've all seen what the dollar has done this year. I mean, the ultimate question, right? And this, I don't remember if this is a phrase that came from you or somebody else's, but it's the idea of balance sheet contamination, where you just sort of keep migrating the bad debt up and up and up from the people, or from some of the people, or some of the lenders, or some of the insurance companies into the government, and then from the government into the currency. And then a normal currency would obviously devalue in the face of that contamination. But the longstanding bet, and I think largely correct, I mean, I don't have to say I think largely correct, it's self-evident correctly, is that they could get away, meaning that the policymakers could get away with jamming the contamination into the currency without meaningful impairment of the currency because of the reserve status and the lack of an alternative place for anybody to go. They're not going to go to the euro. They're not going to go to China, on and on, all the things that they're not going to do. And that we're basically in this game of chicken where you can have this sort of reckless, or I won't use an adjective, that you can have a specific central bank policy that is liberal in its transference of in its manufacturing of currency and its transference of liabilities into the currency in a way that is tolerated only because of the reserve status and the belief that the reserve status is so secure that fairly aggressive contamination can be tolerated. And I would say that that's been largely true for the last 10 years.
Yeah, the fact of the matter is there's no, when you talk about the currency market, it is literally a battle of wits amongst unarmed opponents. Because as flawed as the dollar is, for reasons we've discussed, the euro has problems, the yen has problems, and so on and so forth. So I have believed for a long time that the end game, if you will be when the bond market no longer cooperates with the Fed. And my shorthand phrase has always been, the bond market will take the printing press away from the Fed. And people say, well, what do you mean when you say that? And what I mean is like this. Last year when the Fed eased, say 10 years and out, the rates didn't come down. They actually went up. And people rationalize that for a group of different reasons. And then eventually the election came along. There's been all kinds of, action. Obviously Trump is trying to get as many friendly Fed governors on the Fed as he can. And their plan will be to lower rates, run the economy hot, try to grow our way past the deficit. I'll be nice and not say inflate our way past the deficit. And that's one of the reasons why they're now allowing the banks to lever up on the short end to try to have buyers for the debt. But what I think is going to happen, I don't know if it'll happen this time, but one of these times the Fed's going to cut rates, and again, say 7 years out, 10 years out, 15 longer paper rates will go up. The curve will steepen, and the bond market won't cooperate with the Fed. That's that hasn't happened since before Volcker. And once that happens, that's the contamination I think you're speaking of. Mm-hmm. Sure, we can get some weakness in the dollar, but for the reasons we said, it might not be the most obvious problem.
But it's not the currency, that it doesn't manifest in the collapse of the dollar. It manifests in the inability to reduce rates.
To get market rates.
The long end.
10 years out. Yeah. They won't play ball. And if that starts to happen, then we'll probably get yield curve control. They'll take a page out of the Japanese book. The Japanese, for those who don't know, monetized about half of their debt. Their debt to GDP was much higher than ours, but they've monetized half of it. Now they just haven't wanted to raise rates. So I think what your yield curve control will happen here too. Maybe that'll impact the dollar, but I think the bond market is going to be the canary in the coal mine, that we're kind of at the end of the game that they've been playing for 2, 3, 4 decades. And
you imagine, I mean, obviously nobody ever knows anything in terms of timing, but if you were to sort of, do you feel that a scenario where the bond market is increasingly less, I mean, I'm just going to say one quick sidebar. People talk about that. Oh, well, what Trump's going to put in a new Fed governor, and my attitude has been, well, okay, if Trump does that, the bond market's going to do exactly what you just described. There's going to be Trump and everybody else is going to be sorely disappointed when they take over the Federal Reserve. The Federal Reserve cuts rates, and consumer rates go up and long rates go up. And now you've really lost control of the situation.
Yeah,
the market sets the rate.
They might be able to bring the consumer rates down because those will go off the short end, but they won't be able to bring mortgage rates down, and they won't be able to bring long-term financing rates down. And then they'll probably step in and use yield curve control to force that to happen, right? And then the outlet might be the bond market. The currency market. But the point is that you have to have enough gray hair to have been around long enough to have seen some of this in action and the psychology and the leftovers of that. I started the investment business in 1980, but I had seen enough in the 70s. I talked to guys who've been around, and I can see that this shaping up. So I'm excited. I was really excited for the last rate cut to see if this would start to happen. It did. I even shorted some bonds for a while, but not that that matters. But I think this time around is going to be extra interesting because I think it's like a slam dunk that longer rates will not come down when they do this, and that's going to be a shocker. And then we'll see how they play it from there. But that is the beginning of the end game of this money printing thing that we've been doing for so long. I think we'll see.
So, yeah, and so I mean, is your I mean, not to get into sort of a buy 'em, pick your favorite sort of trade kind of scenario, but like, are you at the point where you believe being short the bond is a good idea at this particular moment? Do you have a point opinion on the 7 to 10 year from an investment?
Yeah. So full disclosure, like when it started, like the last time when they cut rates was about a year ago, I think. I was looking for this to happen. It looked like it started to happen, and I shorted bonds. I was short bonds off and on for a year. When Trump came in November, when the election came in, I thought, I have no idea who's going to say what's going to happen, and I got out of the way. And I haven't had a position since. But now, as I see how these things are developing, I'm trying to find the juncture to start to try that on. But my from an investment standpoint, my major antidote to these kinds of policies, which have been obvious to me that they were going to keep doing these kinds of things for some time, has been to own gold, because it's a currency that doesn't have its central bank behind it and stands on its own. And so these policies that are bad and ones that are even worse tend to cause more people to want to own gold. So I can protect myself owning gold, being long something as opposed to being short something. Short is always harder, but I'm definitely going to make a play and see how it works as we get closer to these FOMC meetings when it looks like they're going to ease, because I think it's going to backfire.
Do you have have you gotten involved since we haven't talked in a decade, at least not in this context? What about crypto? Is crypto a gold prize? Is crypto? What is crypto?
Okay. All right.
I'm sorry to walk you into this.
No. But I have to first, before I tell you my opinion, I have to tell you how smart I am about crypto. So I was at a dinner after a grants conference back in, I think it was 2011, 12, 13, somewhere in there. Bitcoin was $600. I heard a really interesting presentation. So I go start digging up research. I talked to all the smart people I can. I decided I couldn't figure out what its economic connection was. In other words, there's no utility to it. It's a thing that goes up in price. And even though the amount of Bitcoin is limited, they can fork it, which they did, but there's an unlimited amount of other crypto coins, and none of them have any utility. So I decided to pass. Now, I passed at 600. It's now 111 or 12,000. So how smart am I? But what I do think is going to happen is tokenization. And tokenization means that we're going to take a football team, a horse, a piece of art, a hotel, a limited partnership, a restaurant, a winery, and we can create fractional interests represented by a token interest. You can leave it on the blockchain; everyone can see it, and then you will own something that is attached to either the appreciation of an asset or depreciation, cash flow. So it'll be a securitized, electronic thing, but it'll have some utility. I've thought this would happen for some time. It's been rather slow to develop. I still think it will. I think if that starts to develop, that might cast some aspersion on the crypto world because, again, it's no connection. It's just people have agreed that this electronic thing is worth more than green paper, and so therefore it goes up in price. So I couldn't own it, sleep at night, but I missed the whole move. So there you go.
Yeah, I mean, isn't that the same thing as gold at the end of the day? I mean, there's an agreement that a piece of shiny metal is more than a piece of green paper and is more than an electronic thing.
Yes and no. At least with in the case of gold, people have concluded that it's the least bad alternative. It's not that it's perfect, but it's been the least bad alternative for literally thousands of years. So it's not like it's had, a 2-decade run or a 3-decade run or a 2-century run. It's got millennia behind it. And then it has a certain cost of production. You can't just create it out of thin air. That's one of the things that the Bitcoin has, right? Is the guys have to grind through all these complicated formulas. So there's a cost of production for that. So it does have that similarity in that you can't just create it. It's very difficult to counterfeit gold because of its weight, and you can drop it in the ocean and pick it up in 500 years and nothing will happen to it, right? So it has immutable qualities. And so, yes, but it has an aspect of people have to agree that, okay, this is the thing that we think it is. And now in the last decade or so, the Chinese and what's interesting is the world central banks, normally guys that I castigate often, have decided that they'd rather own it than just dollars. So I can make an investment case, the long-term weighing machine, and in the short run, we've got the voting machine from the Asians and the central banks, not so much North Americans. The speculative interest in gold is quite low right now in terms of futures exposure. And you can see in the way the ETF hasn't really had inflows in the way the mining stocks trade. It hasn't been popular with American citizens really yet. But while there's an element, there's quite a bit different between the two, at least in my opinion.
Is your opinion of, because you're kind of you are famous in your way in the financial specifically Greenspan, but in general, just the sort of permissiveness of the central bank and the sort of just the increasing irrelevance. And you're probably not familiar with it, but Tom Sosnoff, who is the founder of the network that we're talking on, is also famous for maybe for different reasons, maybe for the same reasons, for basically saying the Fed doesn't even matter, that the bond market, that the Federal Reserve basically just follows the bond market, that it's an illusion that the Fed leads the bond market, that the Federal Reserve actually follows the bond market. Anyway, whatever the explanations are, I'm curious what your opinion of the central bank is today, and if it has changed at all from 10 years ago or 20 years ago.
Okay. No, it hasn't changed. It's only gotten worse. I'll come back to that in a second. I would argue that I think he's right on his premise, but I think I would agree with his premise if it was this: the Fed should follow the bond market, but the Fed's trying to lead the bond market, and it thinks it can, and it's gotten away with it, but it's about to find out that it can't. I think he and I would agree more than disagree about that. The Fed has, but the cumulative effect of their mistakes and the increasingly larger volume of the mistakes has gotten us to a very bad point, because it has the reset that we should have had after 2008, where we should have done things about, okay, look, we almost all died here. Let's all chip in and give up something, and let's put ourselves on a sound foundation. We're going to means test Social Security. We're going to take, we're going to take a little something from everybody, and we're going to get the deficit down. That we're not going to spend as much crazily. We'll incentivize natural gas vehicles or all kinds of things, and we almost did the exact opposite. We did none of that. We set up nothing. So what the Feds and all the monetization, that like $8 trillion on their balance sheet, I mean, the national debt at $37 trillion is not nothing. But when we went from, call it 13 to 37, 7 of it got bought by the Fed. So their monetization has helped the can kicking and the mentality in Congress, like they don't think they have to do anything about anything. So they're the only ones that can fix that problem. So the Fed has not only
being the Fed is the only one that could say, I'm not for the Congress. But I mean, as long as Congress thinks that the Fed is always going to be there to bail them out,
Why do I want to go sell my constituents on why they have to take some pain, right? And if they couldn't sell them on taking some pain in '08 when people were scared out of their minds, you can imagine what the next crisis is going to have to look like. We're going to have to do this. Now, they're going to try to inflate their way past this. I'm dubious as to whether or not they'll be able to pull that off. We'll see. I mean, I'd like it to all work that way. I wanted to give them benefit of the doubt, but we didn't take long to find out how hard it is to actually cut spending. I mean, you got these guys going in there to do heroic work at Doge, and they got attacked. All they're trying to do is make the government less bankrupt, and people went after them. So it's gonna take an incredible crisis to really solve this. So the Fed has created problems with misallocation from the bubbles, and then they printed more money, and so they've created all kinds of wrong mindset from investors. They did a poor job in regulation, and now they've allowed Congress to think that there's no real reason. I mean, they roll that debt ceiling. I don't even know why they have it. So
nobody knows why they have that.
Yeah.
I mean, but it's an interesting thing because it's like if the first backstop is sort of, let's say, the board of directors and the CEOs of the financial, the first backstop to mismanaged risk, I would say, is the CEOs and the board of directors at the banks or the financial institutions, and then the next backstop would be the Congress, and then the next backstop would be the central bank, and basically all those backstops have been a clean pass going back certainly to 2008 and maybe before, but maybe 99, which leaves your final backstop to be the long end of the bond market. And then after the long end of the bond market, maybe it's the U.S. dollar, right? As the sort of final piece. But it's pretty apparent that the first three backstops, meaning the financial institution boardrooms, the Congress, and the central bank, no one is incentivized to do anything other than accommodate the short term, the can kicking, basically.
Correct.
There's no incentive not to kick the can.
Correct. Because when you bring up the issue, when you bring up, hey, we got to take some pain, well, they say, why? Well, this is going to, look at what Stan Druckenmiller did. What was it, 10, 15 years ago? Stan went around to colleges trying to say, hey, you kids, you need to pay attention here. You got to demand change because otherwise you're going to have to pay for all this wealth transfer that we can't afford. You can't afford. He got nowhere. I mean, it's mind-boggling.
Well, but human nature, right? I mean, it's sort of as long as your human nature is the most powerful, the path of least resistance. All the sort of most primal aspects of humanity are in play here. What is the most negative scenario? Like, what's the risk? Like, I mean, and I'm not trying to alarm everybody, and who knows what's actually going to happen. But what do you see as the sort of outlier risk of failure to address this?
There are two risks, two big risks, big risks that are not really timeable. So the first one is if the Fed loses the ability to monetize and come in and try to clean up the accident, like I'm postulating, that's a real risk because now if that happens and the economy stumbles or the stock market has a bad break and then the economy stumbles both, and they can't really ease because people are still worried about, this is happening, but there's still inflationary pressure. Then you don't have the safety net underneath you that everyone presumes that you do. That's one. That's a big one. That probably has a slow fuse. The other bigger risk, which has developed since the last time you and I talked about business in any serious way, has been the development of the passive bid. What do I mean by that? And the guy that opened my eyes to this, and you really should talk to him, is a guy named Mike Green. He's really smart. He's a great guy. And he opened my eyes to this maybe 5-6 years ago. What has happened is that there's been an ever increasing proportion of the market share activity that is done on a daily basis by Vanguard and BlackRock. Why is that? Because corporations have these target date plans, and you go to work at a corporation. Whatever. And they've done enough lobbying that HR automatically, the default is you're in, as opposed to the default was in cash. There's other rules to make it level the playing field, tilt the playing field in their favor. So we have a situation now where that passive bid, and I'm not talking about ETFs, I'm talking about Vanguard has cash because the companies are sending in contributions for their employees. They say, I have cash, I buy. I need cash, I sell. I don't give a shit what the price is. And so when Jack Bogle came up with the idea originally, the idea was the collective wisdom of the market over time gets it right and it does well. And I want to participate in that. The problem is when you get to 40 or 45% where we are now or higher, depending on how you measure it, you are now setting the price. You are one giant voting machine who's put its thumb on the scale. Why does that matter? Well, it's because of the way they market cap weight their things that they have to buy more. The things that can kind of organically and through other speculation can get pushed up in price. Let's pick NVIDIA. They have to buy more. The more it goes up, the more they have to buy because the weighting increases. So they have to buy more to keep the weighting, and it goes on like that.
It becomes a virtuous cycle in terms of price appreciation, whether it's virtuous. I use virtuous in the sense of, I get it.
Quotes. Yeah, exactly. And as a consequence of that, there are other strategies that have evolved that kind of are in the slipstream of that, momentum-oriented things, and they're structured products that are taking advantage of the fact that this has caused volatility to get dampened. And there's a whole lot of mechanical strategy. So you have this mechanical robot that's at work every day. Buy them, right? And so the market isn't human emotion. You can remember how wild emotions got in '08, right? That's raw human emotion. That's what drives markets. Except you've got this passive robot that's in there every day and saying, I'm buying them. So why does that? It will get so big, something will happen, will fall of its own weight. We got a little taste last April. What happened was a lot of the mechanical operators that kind of go on the back of this, they're like the remora eels that go with the sharks, right? Mm-hmm. They were kind of full up, and we had enough bad news. We caught people, and we broke through the mechanicalness. So then it was able to feed on the downside as guys scrambled. Flow of the passive robot who gets to come in every day and buy them. Now, all of a sudden, you don't have that structure, and you've got all this craziness going on, and the market starts to break. And when Mike's done simulations, as you might imagine, when you get to a certain point, and then they come in and try to sell, it's just a vapor lock to the downside. It'd be all hell will break loose. Well, if that happens, for whatever reason, it would most likely be related to either enough baby boomers taking their money out or enough new people not put the money out tips the money in. Then you could have a market crisis. At the same time, the Fed's already been lost their credibility. That's how you get not to an '08 kind of a thing. It's more of a market-induced '87 kind of a thing, even though that was false. That's a false reference point because that was a function of program insurance. But the similarity is in portfolio insurance, not program insurance. Portfolio insurance was they had to mechanically sell on the way down to delever if you'd hired them to do that. Vanguard and BlackRock, there's no discretion in their selling. It'll be the same exact thing.
Because you're saying the robots will liquidate even faster. There is no the same way that the robots are always buying in the scenario you're describing. That's why you get a combination of a free fall in equity prices at the same time that the Fed has lost credibility to intervene.
That's how those two
worst case scenario.
Yeah, that's how the two nightmare scenarios intersect. And
it's
so
like the shark latent hurricane.
Right. And you have to go out in the water.
Yeah.
So the passive bid is something people need to be aware of because they have to factor it in what they're doing. They have to, as Mike Green likes to say, you have to understand the rules of the game you're playing. They might not be the game you think you are playing. So people that think that the stock market is the same one that's existed for the past 50 or 100 years, it is not. It's completely changed in the last 15 or so as that market share is tipped up. And then the QE that the Fed's done is help that along and change the attitudes and things like that. But the thing the big piece below the iceberg is that passive bid and how it operates. And if
circle back to something that's even, I'm not going to prioritize. It's all sort of a high priority discussion. But I feel like, because you're not the only person, Chris Vecchio and Ilya, who are the two, Ilya Spivak, who I normally sort of host this discussion with, they were talking about yield curve control. Is they agree with your assessment, which is that the bond market is likely, that there's a higher chance than ever that the bond market will not react the way that the Federal Reserve would like at the long end, and that if and when the bond market does not react the way that the Federal Reserve or the president would like, that the next step in that is yield curve control, a la Japan.
Yeah. And also,
my retort to that is, I don't see how they can get away with yield curve control without really creating a currency problem, like that this really compromises the credibility of the U.S. financial markets. At that
you want me to sell it to you?
Sure.
So they'll say, because Scott Besson is not a dumb guy. He's a very smart guy, and he knows. They'll say, look, I know your hair's going to be on fire because it sounds like we're monetizing bonds, and that's not good. It's going to lead to inflation. ETFs along the way, and guess what? It kind of worked. And if they'd have made that an argument a year ago, it looked like it did. Now Japan's got a bond market problem of its own because it's now led to some inflation and all that. But the phase of the monetization actually worked. In the same way, if you keep drinking, it works. It only doesn't work tomorrow when the hangover shows up, right? So the delayed reaction to what's going on in JGBs is probably related to that. But he'll make the claim it's not inflationary on its. They'll try to sell it. And if they do enough of it in the beginning, they might be able to hold the bond market in place and say, see, it didn't.
And you don't think that, because the dollar already had a big swoon here in the first half. The dollar proved that it can get weaker. Materially weaker.
Yeah, and if the Japanese started raising interest rates, then the yen will really move, and that'll matter too. But what I'm saying is, I think they'll try it, because I think what they've concluded is, look, we tried talking about Doge and austerity. That lasted 5 minutes. We have no choice. If we have no good options. I'm gonna give you the patriotic case for the policies that I already told you were bad. Look, there's no way out. So we can slam on the brakes, cut spending, do all this draconian stuff, and eventually we'll come out the other side after a 3 or 4 year recession. No one's doing that. So what we've decided to do is we're going to try to grow our way past this debt. And here's how it's theoretically possible, and here's how come it won't hurt, and they'll try to sell it. And so I think that you could almost have a patriotic view. Look, this is a bad outcome. This is a bad path, but it's the least bad path. I think that's what they'll say.
Right.
And if you phrase the argument that way, I would say, yeah, that's probably true. However, the long-term impacts of inflationary policies are usually more pernicious than just taking the pain. If they'd have done the right thing in 2008, we could have been set up for the next 30 or 40 years, right? So it's always the path they picked is also easier. Now, of course, Trump didn't control Congress. So I'm not saying they could have done, if they made us king, you and I, king and co-king. He said, okay, look, folks, this is going to hurt for a while, but your kids and grandkids are going to be better off, and you got to bite the bullet. We're going to go through the hard times and all that. We could come up with something that we'd be better off down the road. We'd never be able to sell that package to anyone, right? So that is the reality. So it's almost like I can live in an ivory tower and say, well, they should do this and they should do that. But they definitely had a terrific moment in 2008. And I think the Obama administration should be criticized for doing zero with it. I mean, I gave plenty of criticism to the Fed they had the administration then. They had the moment. They had the guy. He was a great salesman. They just didn't prioritize this, right?
Mhm.
And in the interlocking of finance and politics, I look at it this way. My view is you have to have a sound economic engine. If you have a sound economic engine, you can throw off capital and things like that. And then you can take that money and try to do good works and fix the wrongs for the people that got left behind and had bad luck and do all the things that you want to do if you're a good person. The problem is, I think some people, they only focus on the second part. We want to do all these good things, and they don't realize that sometimes their approach to those good things destroys the economic engine. And if you destroy the economic engine, you got nothing, right?
Mhm.
And I think that was the mistake the Obama administration made. They got too focused on what they want to do and didn't understand, hey, wait, we can do even more if we fix this problem here. But they missed that chance, and that was the last good chance I think we're going to have.
Artificial intelligence is something that obviously is the sort of now the conversation, the dominant conversation for all the obvious reasons. You can go at this many ways. Obviously, nobody knows anything other than we all know one thing, which is it's here, and it's going, and it does, it does a lot of things.
Yeah,
we're all impressed by it, and every day, anytime you use it, you're more impressed by it. No one, I don't know anybody that's using it at this point that's not this, increasingly impressed by it. If you weren't impressed by it a year ago, you come back to it, you're like, oh, wow, all those things. Then you kind of get into the speculative piece. Okay, well, what does this mean for the labor markets, particularly all the entry level jobs? Entry level accounting, entry level programming, entry level, and all the sort of entry level white collar, entry level legal, all that where you get, people are like, okay, well, why do I need that first layer of labor? I'll now use the robots for that. I'll have senior talent manage robots instead of senior talent training young people. And so I'm interested in sort of your perspective, not on the market side, but just on the social aspect and sort of where, understanding it's speculative. That's one sort of world of discussion. And then the other world, which is sort of the comparisons between the market's behavior right now in the context of what we saw in 97, 98, 99, with all the names I'll use Sun Microsystems, but it could be WorldCom, it could be Lucent, it could be AOL, blah, blah, blah. And you can start either way, but compare this to the late 90s and from a market perspective is one interest, and then the other is, the humanity.
Yeah. Okay. I understand the question. First of all, your point was you did an excellent job, I think, of setting it up in that there are things that it does that are time saving and it's going to cost some levels of jobs. But people need to keep in mind, though, is it's not magic and it's not people thinking. What it is the evolution of hardware and software that's been taking place for the last 50 years. For instance, I programmed computers in the late 70s, and I worked on this room-sized computer. And even back then, we had parameter-driven programs. In other words, that's I could put a parameter in a program, and it would cut some code for me. So breakthroughs in software and all of that, we have this incredible speed with which the machine seems to figure out stuff, right? And it is incredible, and I think it's especially negative for search because you go to try to figure out something, and now you get a halfway decent answer without 55 ads. So
that's search for sure is the obvious sort of anyway.
I think that's collateral damage for the guys at Google. I'm sure they got some workaround, but in any case, so it's very useful. But it is one of the original glib statements about programming or computers is garbage in, garbage out, right? So if this large language module goes to work on, himself, and they asked, asked about himself, Fred Hickey, and he found out that he was dead. The thing said he died a year before, right? So, you know, there are going to be serious ramifications. I don't pretend to know them all, and you ticked a lot of the potential negative ones who might be hurt by this. We can see how we'll all be helped. But from a speculative standpoint, this is, I think, a bigger potential bubble in terms of misallocation of capital than what we saw in the internet tech stock craze of the late 90s. Because here's the problem: is I didn't know we were going to talk about this. I don't have data at my fingertips, but I got the scale of it right. The people that are making the money in the AI are the people selling the picks and shovels to the prospectors, right? And the problem is there's been all this massive amount of capital spent to build this out in terms of data center, whatever you want to talk about, and there's no real ROI yet. No one's figured out how to monetize this. And it's been a while now. And at some point, some of the amortization charges that Microsoft or some of these companies are going to have to take are going to be real drags on earnings. And I think that's why you've seen some layoffs at Microsoft that may have been packaged to look like, well, this is a consequence of AI, but it might be the fact that they've got to cut spending to some degree. We haven't seen very many real negative stories. So I think from an investment standpoint, it's extremely dangerous because the premises, I think, are unlikely to come true in a way that will justify the stock prices. And particularly if you're an investment in a company who's financial market risk, and the other ones are trying to figure out whose jobs impacted more than the others is far more speculative than seeing the fact that there's no real return on investment for these things yet, and that danger.
I think any insight, because I know you've have spent decent parts of your investment career shorting things, one period, which is something that Tom, who I've referenced, has also spent a decent amount of his time short things. And when you live your life short things, you're frequently right, but you're frequently right at the wrong time, and the cost of waiting is so high that by the time you're right,
you're dead.
It's not that much fun.
Yeah.
And whether it's short the bond, waiting for one of these types of scenarios to play out, or whether it's picking a basket of Nvidia, Microsoft, Meta, whatever. And so, is there anything that you have learned either in the late 90s, which would be the best comp for this, or just as a short seller who has lived to fight enough days? Is there a way to approach this perspective from a trading or speculation standpoint that is useful? That's not just rhetorical.
Not yet, I don't think. One of the things that I learned, like I ran my short front for 12 years, and when I closed it down at the end of 2008, it was because the Fed was starting on QE, and I knew that would make short selling difficult. I didn't know it was going to turn out to be what it's been, and then the passive bid that came in later and all of that stuff. But I had certain rules that I lived by to try to help me from getting run over like you're talking about. Harder than it used to be for some of this mechanical stuff that I just told you about. And when you're in a monetary easing environment like we're in, even though the bond market may decide it doesn't like it, you have to be extraordinarily careful about ideas that foment people's imagination, because they can go anywhere. So I wouldn't even consider shorting. I've been short next to nothing for a long time. All I've basically done is hedge some of my long exposure and other things to protect myself against the market. I think there will be a moment in time, and I'm planning on trying to capture it. What exactly I'm looking for, I can't say. You got to factor in this whole passive stuff and mechanical stuff I talked about. Then, I mean, my dream scenario if I was going to try to sketch a moment in time to go after this stuff, would be if Trump says to NVIDIA, okay, you can do whatever you want in China, because right now that's kind of holding them back. And then you'd have a frenzy of epic proportions. If we did that into Fed easing, you might have a setup there where you could take a shot, figure out I'm going to risk this amount. If it doesn't work, I'll come back another day. That's the only way you can approach it. So that's my current thinking about what might be a great moment. I have no idea how it'll play out. I have no idea if I'll take a shot against it. I think I will. Hopefully, I can find a way to do it where I don't, I'm not going to expose myself to a ton of risk, because you can easily get your head torn off. But for me, I'm more interested in doing that side of it than I am to try to get on the long side of the train at this juncture. So.
And so this has been a good hour, as I imagined it would be. So thank you for the time. I got a couple of minutes on the way out the door. I want to kind of finish where we started, which is, what is your sense of the health of the financial institution? At the end of the day, when we got into this discussion in 2008, it was because the financial institutions were levered, implied leverage of 100 to 1 because of the stuff that was off balance sheet, because of the credit default swaps, even though they were reporting 10 to 1.
Oh, I got to tell you this before I forget it. It's on the topic you just asked for. Okay. So I was at dinner on Friday night with a friend of mine who was very, very plugged in a lot of different areas. And I don't have the details because there was a lot of wine involved with dinner. And he's traveling now, so we haven't had a chance to really sit down and talk about it. There are I'll leave the names out because I don't have everything exactly correct, but there are companies, there are entities that are trying to raise debt, like debt packages against data centers, like raising $20 and $30 billion with no recourse. So that would be like,
So to be clear, you're saying that basically somebody's saying this data center that's underneath an AI super farm or underneath Amazon or whatever it is.
I want to raise money specifically for my data center. I need to borrow $25 billion. With no
recourse. You're long the data center as a lender with no alternative.
Correct. And he said,
but the point is that the financial institutions are granting those terms, not just that
I don't think it's going to be the financial institutions this time like it was last time. They're in pretty good shape, and I think they're not going to be. I think it's private credit that's doing this. Again, I don't have all the details. I only heard this like a few days ago. But like standalone facilities, so there could be, and they're setting up special purpose vehicles to do this. Now they could end up in the banks. What I asked my friend was, let me know when they're trading credit default swaps on these things. Anyway, so that's a story to be continued. I don't know where that's going, but that's going to be interesting. And that's all part of the speculative frenzy that you were talking about.
And also just sort of the health of the institute, the health of the credit markets and the degree to which we're just over levered.
But this time, I don't think the credit problem is going to be the banks. I think the credit problems are nestled away in PE firms and private credit thing. It's all there. It's not necessarily in the banking system, at least not right now. I don't spend any time worrying about the banking system right now.
What do you worry about? What are you the most worried about? That's my last question. What's top of mind as a point of concern, and what's top of mind as a point of optimism? Like, what do you like the most, and what do you?
Pass a bid and when that wrecking ball is going to happen, and investments, and how safe is it to be in that? So I worry about that side of it. The optimism part, I guess, is that maybe they can pull off this growing our way past the debt, and it won't be as bad as I think it is. I tried to be optimistic about it. Now it seems like it's impossible that it's going to work. I hope it works. I don't think it can. So I'm preparing for the worst and hoping for the best on that score.
And do you have a bond market opinion over the next 2 months, 3 months?
Well, I'm going to wait and see. As we get closer to the FOMC, I'm going to find a juncture and put on a bond chart and see how it works.
With a bias to be short the bond or not? It's a bond chart.
No, I'm going to put on a bond short and see how it works. I mean, I'll put it on and I'll say, okay, if that's happens that way and it's negative, then I'll have a hedge against some of the things that I own.
Yeah. Bill, I hope we don't wait 15 more years. Probably on me.
No. We definitely can't. I love talking to you so much. It's so great. Yeah. You're the smartest and best guy ever to grace financial TV.
Well, I appreciate that. I don't know if I can live up to that, but the compliments are welcome. I'll take them. So listen, we'll do this in less than 15 years. Thank you for the hour.
For sure. All right. Thanks a lot, Dylan.
Bill Fleckenstein, everybody. We're back with more Tasty Live and Ilya Spivak's Macro Money right after this. We'll see you again.
Oh, NVIDIA, how you toy with us. The biggest company in the world by share in the S&P 500 reports results. Those results underwhelm. The markets don't like it, but they certainly don't take the sentiment hit. Now what? This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we're going to explore what happened here and look ahead to the next inflection point in this story that is going to come at us to close out this week. And that, of course, is going to be the Fed's favorite inflation gauge, the PCE index. And of course, a very relevant part of the story here, because as ever, we are looking at a market that came into this week focused on the Fed and now looks as though we are going to be finishing the week in the same fashion. The story, of course, was relatively positive with that lead, but it didn't quite materialize that way this week, perhaps until now. Let's unpick what happened here first and foremost with this NVIDIA report and why it did or did not give us a sentiment a lead, and go from there to see what could be approximating next steps here. So let's first take a look at these results. And we can see here, this concludes the so-called Magnificent Seven reporting period. We get slightly better than expected outcomes. We get a slight beat on EPS, we get a slight beat on revenue, but ultimately nothing controversial and nothing out of sorts. In fact, if we consider here what these results actually amount to being, they're not exactly the most chipper of even NVIDIA's own results. So this was a beat of 4.12% on the EPS side. That's the smallest beat since the third quarter of 2022, when earnings disappointed to the tune of almost 18.5%, a little bit more, 1.51. That was the smallest beat since the fourth quarter of 2022, when we only beat by 0.6%. So these are nominal beats, but they're not anything like some of the larger outperformance readings we've seen from NVIDIA before. And as we discussed leading into this report, the other 6 of the Magnificent Seven here likewise beat on their results, some explosively. And of course, Meta is standing out here crystal clear with a 7.14 EPS against an estimate of 5.85. Clearly, a massive, massive gap there. In fact, the only one that didn't beat is Tesla, which narrowly met its EPS forecast. So we went into this having seen those beats already, and then having looked at how the markets responded and concluded that the bar seemed to be relatively high for NVIDIA to deliver results. We can see here the Roundhill Magnificent 7 ETF. There go the Google and Tesla results. We can see the grouping as a whole is basically listless. Then we get the results from Meta and Microsoft, and of course we just saw those Meta results in particular were absolutely off the charts, and so they get reported after the close. We get a gap, but then the markets faded, and faded some more when we get was the bar for these AI linked and tech stalwart names is high. In fact, we were looking at this subsequent rally in the market as a whole. There's that Mag 7 ETF. There's the S&P and the NASDAQ, and we've used the ETFs here, SPY and the Qs, just to make sure that we're lining up our data as cleanly and as analogously as possible. And so we have the reporting period right here. So you can see that this was from the 23rd through the 31st. There is that period right here from the 23rd to the 31st. And we can see that, indeed, we are listless. We fade Meta, Microsoft, and the last part of this reporting period. We then have this. And we can see, likewise, that it is more so a change in Fed policy expectations that gives the markets a broader fillip than it does any of these earnings reports beating expectations. There's a clear downshift here in the Fed funds expectation that's priced into December's Fed funds futures, which is what this is. This is the implied rate. We can see we take a step lower here from north of 4% down to 3.85. So this downshift here seems to be the catalyst until we get into the US CPI report on something of a wall. Of course, that wall, depending on where you look, has started to get breached on the upside. More on that in just a second. But we came into this NVIDIA report with having the preceding Mag names, Mag 7 names, having delivered and over-delivered, in some cases, obviously Meta most obviously, and the markets having yawned at it and said, you know what, this is just not impressive enough. And as we can clearly see from NVIDIA's results here, the narrow beats, the sort of in-line-ish outcomes, clearing the high bar is not exactly what this looks like. Now, because the bar was set high and because these names are such huge parts of the weight in the S&P 500 index, which is sort of the benchmark for risk appetite market wide, and indeed NVIDIA is the biggest, we reckon that we might have a situation here where this isn't just about one company or a set of companies. This is about sentiment. This is about the overall market mood. And if the bar is high and the market mood is at stake, then a disappointment doesn't just hurt NVIDIA, it probably hurts the broader market. Moreover, we came into this with a bit of idiosyncratic risk. We can see that the expected gap on NVIDIA's estimate for fiscal third quarter revenue is yawning. It's much, much bigger than anything we see over the preceding several quarters. And that's because we don't have clarity on what's going to happen with shipments to China. First, we get a ban on chip shipments to China. Then the Trump administration has a U-turn and says, well, actually, it's fine, go ahead, but you're going to have to give us a 15% cut of everything that you sell. And so it's unclear then whether the forecasts for revenues will include China sales, not include China sales. And so there's this big disparity here that the markets are reckoning with. So what happens? Well, as we just said, the results were not especially impressive relative to expectations. They beat by very narrow margins, and in fact, the smallest margins in quite a long time. NVIDIA approved a $60 billion share buyback. They said there were no sales of the H2O chips to China in the second quarter. And on that key revenue point, they only projected 54 billion plus or minus 2% for the third quarter, which was against an estimate of 53.5 median. But so we can see the disparity here is huge. It runs from under 50 billion to well over 60. And at 54, we're sort of obviously erring on the low end. So the markets did not like it. They sold off as one might expect. So did this sink sentiment? Well, the clear answer is it did not. Moreover, NVIDIA actually ends up finishing the day modestly lower. We can see that most of the drop is erased. These are 4-hour bars, by the way. Most of the drop is erased, but we still end up net lower relative to where we started this story before the earnings report came out. But this clearly does not extend into a broader risk-off mood as we get into today's market action. So we can see here, this was the week up to the close before the NVIDIA report. We can see stocks are listless. There's a little bit more follow through on the bond side, especially at the short end. Yields a little bit cooler. Gold's a little bit higher, perhaps thanks to what's going on here. Gold is sort of a preternaturally anti-yield kind of creature because it doesn't actually yield anything. The dollar is nevertheless stronger, and Bitcoin, the risk appetite on steroids asset of the bunch, it's still down significantly on the week. So we come into the markets kind of idling. And this is what happens with week-to-day performance the day after. So clearly, in the wake of NVIDIA and in the wake of this disappointment, which the markets clearly present as disappointment. So there's no question here that the market saw this and said, this is not good news. Nevertheless, the market says, yeah, but it isn't damaging for sentiment, and in fact, it is going to be good enough. So we end up with now much more convincing gains for the S&P and the NASDAQ for the week. I mean, compare this with where we were for the week yesterday, and that's clearly on display. We get a little bit of a reshuffling on the bond side where we even out a little bit. So the decline in front end rates moderates a little bit. The back end extends out a little bit. Gold continues to build, and the US dollar gets closer to even. So it's still a little bit higher on the week, especially against the euro, but against the more yield sensitive and the most kind of directly yield sensitive yen, we're back to neutral, having been much stronger earlier in the week. And Bitcoin is still Bitcoin with basically the same move. Now, this starts to look a little bit more like where we ended last week in the wake of a speech from Fed Chair Powell that the markets judged as setting the stage for rate cuts in September, which was an idea that they roundly cheered. We can see stocks had a nice day higher, yields fell, gold was up, the dollar was down, Bitcoin was sailing. So we had a very clear-cut response, but the markets did not find follow-through in that response this week. Again, as we can clearly see here, if this was the lead-in, then we did not pick up that baton on Monday. This was the week, Monday through Wednesday. No follow-through in stocks. Dollar goes the other way. Bitcoin goes the other way, and we get some modest follow-through, maybe on front-end yields, maybe on gold, but ultimately nothing deviates from long-standing ranges. So it's very interesting that what we have is then an NVIDIA report that disappoints and sentiment recovers. It is as though the markets reset after this report to say, all right, well, the big event risk between Powell's speech on Friday and the next bit of Fed news is going to be this NVIDIA report. We're not going to make a bet until that report comes out. Once it comes out, as long as it isn't catastrophic I don't think is what this was, though clearly a letdown, as the price action itself attests, we end up with essentially getting back to saying, okay, well, that was fine, and we can get back to talking about the Fed. That, of course, brings us to the next inflection point. The PCE index, the personal consumption expense, mostly anchoring policy around. And the expectation here is that we're going to get an uptick. This would match which way CPI went earlier in the month. But of course, that CPI report ultimately ended up giving the markets a lot of clearance in their thinking about a Fed rate cut in September, because while inflation went up, it did not go up in a way that ruffled any feathers. The expectation here that we're going to go up to 2.8 on the core. That would be the highest since February, and 2.6 on the headline. That also the highest since February. So we're looking at essentially 5-month highs. And when we look at the CPI number, we have something similar. CPI came out at 2.7% headline. That was a 5-month high, although the expectation was it would be a little bit higher, that it would be 2.8, and that's ultimately why the markets seem to be relatively enthused about those results. The core number, though, 3.1%, again, 5-month high, and higher than expected at 3. So we're looking for PCE to broadly match what CPI gave us. And of course, let's keep in mind, CPI is already, of course, priced in. So where are we on Fed policy expectations going into this thing? Well, we're still hovering comfortably at about 85% chance that September will give us a rate cut. We can see that that's held relatively steady versus the pre-NVIDIA world of yesterday. We can see it is much more conviction than where we were just ahead of Powell. That was sub 80%, and certainly much more convincing than the wider spread a month ago in late July, where the markets thought, okay, there's about a 35% chance that rates stay unchanged. There's just over a 60% chance that we get the one cut, and then there's even a possibility that maybe we get a 50 basis point reduction. But of course, the markets disabuse themselves of those extremes in short order. And so things over here look pretty stable, and the level of conviction looks pretty solid. Perhaps the larger issue is that there continues to be a dramatic disparity between what the markets and the Fed expect for next year. Now, since basically the middle of May, the markets have been comfortably anchored around the Fed's forecast for 50 basis points in rate cuts this year, give or take here and there. And of course, the markets don't move in straight lines. You're bound to get some wiggling around these levels, but we can see that there's a clear sort of range that is established right here. And of course, the Fed has been saying that they're aiming to cut rates by 50 basis points this year, going all the way back to December of 2024. That forecast has not changed. So the markets are with Powell's speech on Friday last week that indeed we're going for this one cut in September. That leaves October and December for policy changes, and the markets seem to think, well, they've gotten themselves this far. This is about where we're going to land. The disparity is about next year. In its latest update of the forecasts here, the Fed said we're only going to do one 25 basis point cut next year, whereas the markets have only moved in a more dovish direction recently and are now at 81 basis points for next year. So that means 3 cuts are all the way baked in at this point. So that's already 2 more than the Fed has owned up to. And then when we get to benchmarking what happens with a 4th move, because indeed we are here in excess of 75 basis points, which would be 8% chance that there is a 4th cut on the menu here next year. So the disparity between the markets and the Fed clearly continues to be yawning. And the markets are, of course, much more dovish than the Fed has owned up to, at least at this point. Of course, in September, the next policy meeting, we are going to have a revision of these summary of economic projections, readings from the Fed. So we'll see if they've moved any closer to where the markets are, let's say from 1 cut to 2, at least to show some direction, some movement in the same sort of trajectory where the markets seem to be pulling policymakers. So the bar, again, from a sentiment perspective and from a surprise perspective, seems relatively high. These PCE numbers would have to go a long way to telling markets that the Fed is prepared to make a shift in this much more dovish direction. They would really have to be very, very convincing on the soft side of expectations for the markets to go, yes, well, there is a 2+ rate cut difference between where we are and where the Fed is, but these numbers will surely shift them in that direction. So the markets are already so dovish that it would really take a very dramatic reading on the soft side to get them to move in some sort of a different direction on the positive sentiment side, to find follow through, at least from this as a vector. Now, of course, as we've just learned from NVIDIA, the markets don't necessarily need for sentiment to follow this or that lead. As long as things are tolerable, the lead can be negative and the markets can shrug it off all the same. But if there were to be a policy lead from these numbers that supports sentiment, it would have to be a significant deviation for how dovish the markets already set themselves up relative to what the Fed has actually confirmed, or at least projected. So what's the likelihood that we get that kind of outcome? Well, we can see that actually the trend has been the other way. So we've seen that the 6-month annualized PCE reading has been increasing, and now the higher frequency 3-month annualized reading has been creeping up. In June, we saw an uptick. In July, it looks like we'll probably see an uptick again. Moreover, the sort of benchmark forecast from the Fed's own modeling, this is the Cleveland Fed's inflation modeling that the markets look very closely to, we can see that realized results in the blue and the red here have increasingly deviated on the upside versus the model. There was a little bit of a convergence in April, but since then the disparity has only increased. And so while it seems baseline that the markets are pricing in higher inflation, that much seems clear, the degree to which realized data has come into the same direction has been much more emphatic. We can see inflation is running hotter than even these projections have it. Moreover, we can see from the ISM Services Index, services, of course, the largest part of the U.S. economy by far, that we've seen a steep rise in the price component, and both PCE and CPI lagged 2 months behind this component, would probably be expected to go up here, were this to hold. This is the big surge in what seems to be massively accelerating reflation, and we're just in the window for it here. So, with this in mind, the question becomes, what are we going to learn from these numbers that is going to give the markets something adjacent to this kind of a response? Risk on because easing. And the bar, again, seems very high, much as it did for a positive sentiment boost from NVIDIA. That did not change that we still got a positive sentiment response, not because of NVIDIA, admittedly, but in spite of it. Perhaps because the markets went back to where they were here and said, well, sure, the AI narrative may be getting soggy, but nevertheless, these rate cuts are coming. Let's reset for that world here. And so the key question for us is going to be, are we going to get anything from these numbers that we don't already know, having fully, or at least certainly for the most part, discounted a September cut? So these numbers wouldn't tell us anything different on that front unless they wildly deviated. And are they really going to change anything in this disparity in a sentiment positive way for markets that want rate cuts? Probably not. And so the question then becomes, are traders prepared to just close their eyes and keep the rally going? Or will we finally get to a place where this market will have run out of sentiment positive catalysts, or at least sentiment positive, sentiment devoid of catalysts or refusing of accepting them? That we're going to have to find out as the week closes out. This is macro money for this week. We are, as ever, here Monday through Thursday, right after overtime. Show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. We return on Monday next week. Back to regular scheduled programming, Mondays and Fridays on Futures Power Hour with Chris. First call next week is going to be on Monday with Chris and Tom, a day later rather than Sunday, because, of course, the Labor Day holiday is going to keep things offline. Still writing for the news and insights portion of tastylive.com as ever, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you want. Good luck out there. Macro Money's back next week.
What is going on, everybody, and welcome back to Risk and Reward. Today's Thursday. It was a really slow kind of day, but we'll circle back around to risks of the week that we put on this last Tuesday and get into some of the more buzzy headlines that we're going to get into here in a moment. But I hope everybody's doing well. Gus, my brother, how we doing?
Yeah, I'm doing good. It's been a slow grind upward today, and that's sort of been the trend. I feel like for the last 2 weeks ish. Really, is just these little tiny green days. Nvidia, down inside move after earnings yesterday. It wasn't enough.